Good morning, folks. How are you? Give me a second here. Stupid OBS is for the folks that use OBS for live streaming. The window capture that I try to use, it never populates the chart. So I'm not sure why it doesn't do it, but it fights me. I'll go over these levels in a moment. Just give me a second. I just want to make sure the audio is coming through. Audio check. Audio check. Audio check. All right. So anyway, good morning. Hope you're all doing well. So yesterday we had a short session, and I had a meeting, and my wife texted me, don't forget to do this and don't forget to do that. So it was kind of distracting yesterday. But I'll have a review with my son, most likely this evening. That'll go up on his YouTube channel tonight. All right, so we have the NASDAQ. We've had a really nice run up for this week. You can't hardly see it here, but that is it's two levels. It's the upper quadrant of yesterday's opening range gap. I'm sorry, opening range. It's the upper quadrant of that, and then this is the opening range gap high. Yesterday, because I was doing too many things at the same time during the live stream and trying to communicate with my wife in text above me. She was running out the house, so I had a lot of things going on that distracted me. So in advance, so that way we know going forward, if ever I have something going on during the times that I would normally be live streaming, I'm not going to live stream. It's just not enough bandwidth for me to work with, and when it's such a short span of time. Very distracting, but nonetheless, this level it's actually two levels here. It's the upper quadrant of yesterday or Thursday's opening range. Okay, and I'll show you what that is in a second. But it's also 20% of the weekly range. So that's TGIF. So we have the market trade and reach down. Remember here, all the way down into this level here, which is both the upper quadrant of yesterday's opening range. That means it's the 9:30 to 10 o'clock range. Whatever that is, you measure that. You get the midpoint, upper, lower quadrants. And then you have the 20% retracement of total weekly range. Okay, and you can take a second and load up your weekly chart for NQ for September's contract. Take your fib, draw it across the highest high and the lowest low, and mark it with the Fibonacci levels here. It would look like this. Okay, 0.75, 0.25. That's for quadrants, and if you want to do it on the TGIF, I always just toggle the 5 here off in there, and that way it'll show the 20 and 30% respectively. So it would look like this. That's what your fib would look like. Not that I'm anchoring it to anything right now, but you draw that from the low up to the high, because it's an up close. It's an up week, so you draw from low to high. That'll give you your 20 and your 30% respectively. I'll do it tonight as part of the exercise, so that way Caleb can learn how to do it as well, and you'll have the benefit of seeing what it's like and what it looks like. But there was two levels there. It's the upper quadrant, and it's the 20% TGIF, or 20% of the total weekly range thus far. Not to say that it can't make a higher high on the week. I'm just saying that usually, as I mentioned on Monday, this will also be in the review as well. Monday's trading, I mentioned how we can use the previous week if TGIF doesn't form on the Friday of week of. Then when you carry over to the next week on Monday's trading, you can look for it to 20 to 30%. And you'll see that it did that very thing on Monday as well. But just you notice, just know that that's what will be part of the review. Also, some of the technical things I want my son. He has to show what it is that I'm asking him specifically to do, so that way he can more or less mimic it each day and at the end of the week. So you'll also have the benefit of seeing that in addition to him. And there's the TGIF, 30% of the range. So if I was to take it like this, I did this, you can see it's the TGIF 20%. It's just me drawing a line. It's not an indicator. I'm sure somebody over at Lux Algo will probably create it. Make sure you put my 3 letters in the name of it. So the confluence of that, and then trading down to it at almost 9 o'clock, it's inside the macro. So I'm looking at how we're behaving here so far. It's a little unorganized. At 10 o'clock, we have a medium impact news driver. So there's been a lot of upside delivery. So it's reasonable for it to be trading down like this. I'm going to maximize this chart here. You may be asking yourself, wow, this is stuff that you look at on a day-by-day basis. Yes. Every time there's an opening range or opening range gap, they're 2 different things. If those levels have not been completely used, that means at least explored, tested, traded to, repriced to, I carry them over to the previous day, from the previous day. I do that for 3 days. Okay, so that's for your notes as well. So every opening range gap, if there is one, I carry that one 3 days in the future, and I use it as a look back, as a means of key levels. Very, very, very influential in terms of price delivery, how it reacts, and the wonderful setups form around them. The portion of yesterday's opening range gap is below all of this. This is the opening range gap high. In other words, where we settled the previous day, not yesterday. So that would be Wednesday. And then when we opened up trading on Thursday, that's these 2 levels here. So that in itself also has a range that you can do quadrants on. So you're going to do this level to that level. And again, that's not quarters theory. Okay, you're not going to see anybody talking about opening ranges and quadrants within that. As soon as I start saying things like, a quarter level, a quadrant, dividing into 4s, right away, oh yeah, that's that thing, quarters theory. Go and explore it. You'll see that that is not what this is. But because we're not even near this at all right now, I'm not interested in it. But should we happen to trade down there, should it happen, then I'll plot the quadrants on that, and they will be at that time pertinent. But right now they're not. So where we opened yesterday and where we traded to, in this case, the opening range is the first 30 minutes. That's 9:30 a.m. Eastern Time to 10 a.m. Eastern Time. In my haste yesterday, in my distraction, I typed out these levels here, and you watched me do that in the recording. I did not include the word gap. Okay, the gap is the difference between the previous day's settlement price and where regular trading or regular session hours begin trading. That's the gap. The opening range is how far price travels after it opens at 9:30 to 10 o'clock. So if it's up or down movement, whatever it is, you measure that, and the same thing, you do quadrants on that. That's not quarters theory. Okay, so It's not pivots. It's not anything like that. It's not like off. It's not Elliott wave. It's none of those things. So far, like I said, we're a little unorganized in here. And I think the cleaner price action will start probably maybe 15 minutes going into 10 o'clock, and then into that macro 9:50, 10. So I'm just relaxing, trying not to have too much of an opinion right away, as I want to see what we're doing ahead of that medium impact driver, consumer confidence, or whatever it is, sentiment. Isn't it interesting to see how it reacts off that previous day's opening range high? See it keying off of it here, and keying off of it here. And the upper quadrant, it's keying off of that also, in addition to it being the TGIF 20% level. Okay, so these are all levels that are written on my notepad. Okay, so when I have a notepad, hear the pages of that flapping? That is what I have written down. If I don't have a notepad with me, I will have a screenshot of my notepad so that I can pull that up on my phone next to me. So one or the other, I'm looking at that, or I'm looking at the actual penned out comments. And they're just simply the levels, and I'm abbreviating everything you see here. I don't write all that out. I just write down like number 8, 15. I know what year I'm trading in. And then OR, that means the opening range. CE, consequent encouragement, is the midpoint. That's the highest high and the lowest low of the first 30 minutes of trading yesterday. Don't be confused. It has nothing to do with today's trading, because the price hasn't booked in these levels yet. Not all of them. It's on this one and this one, but they have not explored or delivered to the consequent encouragement or the lower quadrant or yesterday's opening price. Okay, so I'm looking to see if we can make an attempt to get down into that, at the very minimum, consequent encouragement, which is here. Okay, so all of these things here and the actual levels that you see highlighted with the annotations on my chart, and the new day opening gap from yesterday's formation at 6 p.m. and the difference of 5 p.m.'s closing settlement price, which you know is new day opening gap. Those levels are on my notepad, but teaching my son, and you having the benefit of learning this, these are the things that I have on my chart, or not on my chart, or on my price list of key levels. It's on my pad, so that way I can work with a naked chart. So when I have a naked chart, I know what levels I'm looking for, but in the beginning, you're not gonna fully appreciate or understand, neither will he, unless he starts putting them on the chart. Now, you may never want to go to keeping a chart completely naked with nothing annotated on it. I prefer it because it allows me to be flexible. That way my eye won't, let's be real. I mean, I'm a human being like anybody else. And if I see something on the chart and its price is moving to it, the natural order of things is it going to go to that level and trade through it, or is it going to react and give a response and retrace away from it? And if I don't have that line on the chart, it keeps my focus on what is price actually doing. And then I'm constantly referring to, like when you're driving your car, hopefully you check your side mirrors and your rear view mirror periodically every now and then. As a commercial driver, they tell you to keep checking your mirrors, and you don't have a rear view mirror, but you check your side mirrors all the time, because you got to keep a view of what's around you. You're driving the vehicles outside of your own vehicle as a commercial driver. Well, as a trader and watching price action, if you're only looking at one thing, okay, or if you have a distraction, like I don't like when my wife talks when we're driving, because she'll talk with her hands, and my eye goes to her hands. It's very distracting. Or she has this little flash on the back of her phone. When there's a text or a phone call, it flashes, and every time I see it, I want to throw it out the window. So I have to have very, very few things on my chart. So it's very hard for me to try to communicate clear-headedly when there's a whole lot of these types of annotations on my chart when I'm teaching or showing examples. But I get so many times a reference to, hey, can you show us what's on your notes? Like, what are the levels that you have on there? What are you writing down? It's just this kind of information, okay? And it's a couple other things that I'm never going to talk about, but they're not going to be a make it or break it or a success thing for you, okay? It's just personal things for me that I want to have, as a reminder to myself for this individual trading day, that individual week, that are not even that important for you. They're not secret recipe ingredients that causes you to make it or break it, okay? It's just, I'm not making them known to you. And that's me being honest. I could tell you that this is all I have on there, and I would be lying then. But there are other things in here that don't have any bearing on what's going to make price go up or down. So that's the reason why I tell you I don't want to show you my notepad, because there's a few things on there that I want to keep private to me. So we've had a return back into this small little gap in here. All of this is efficient because it's back and forth overlapping each previous range. Then we have this small little gap right there. See that? I'll annotate it with just the lines because I don't want to be monkeying around with the rectangles. They usually fight me when I'm on a live stream, so I'm just going to draw it out like this. It's less painless. So as you recall, on Tuesday, when the market was trading one-sided and it wasn't giving very much retracements, it just kept pumping and pumping and pumping. And I tell, in that live stream, I say that, when it's like this, can I trade it? Yes, but it's going to require a whole lot more things that are going to be plaguing me with new questions and people worrying me, and it's going to cause confusion for my son because they're too advanced. But there are things that I can do. Obviously, as you watched yesterday, there were small little fluctuations both up and down that were tradable, okay? Neither of them, or any of them yesterday, were things that I'm trying to teach him to focus on. And to prevent him from having a lot of hardships, trying to do things that, he doesn't have the skill set to do yet, and most of you as viewers don't know either. When I'm promoting some participation in the day, and if it starts running in one-sidedness, then I'm not going to try to push that for him because it's outside the boundaries of a skill set. I did take a short yesterday. I will include that in the review so that we can see it. I did a turtle soup. I traded like 1.5 handles away from the high and shorted it. And I took one partial and then it came back and stopped me out on the balance. So on 15 contracts, I was able to peel off 5 and then trailed the stop. And then it came back and took that out. But it was engaging with the things I was leaving you with yesterday, looking for some kind of an afternoon retracement, the lunch macro. So you'll have that also in the review. You're looking at this over here, probably wondering what that is, and it's simply just an inversion fair value gap right in there. I'm watching this gap here. I'd like to see that stay open, not even retrade back to. If it does that and we start to break below this low here, the liquidity resting below here, and maybe an exploration down into the consequent encroachment or midpoint of yesterday's opening range. Notice it's not the gap. What we're measuring here is, let me annotate it like this. So you can, for this purpose, you can take a screenshot of this. This is for your notes. It'll be easier for you to see it. That range, in other words, I'm annotating the high level, the lower midpoint, lower quadrant, and then the opening price yesterday at 9:30. This is the highest high it formed at 10 o'clock yesterday. So this range is the opening range. There is no 15-minute opening range. I know it's being bandied about by another YouTuber, but I can assure you there's no 15-minute opening range. It's the first 30 minutes. So this is opening range or first 30 minutes of trading. 9:30 a.m. Eastern Time to 10 a.m. Eastern Time. Okay, so that way you can take a screenshot of that way you have reference of what that is and why I'm annotating it. And you want to have these levels going back, you want to have 3 days worth of it, basically is what I'm saying. So what you're saying is today's, yesterday's, and the previous days. I'm not so concerned about the other levels. I don't have them on my notepad, but you can clearly see right away how fast, if you're doing this, you could have a very, very busy chart. So that's why I keep it clean. I like to keep it, on my notepad, so that way I know what levels it's probably gravitating to, and then I don't have to have all this stuff on my chart, because right away it would look like, just think of someone that has all kinds of stuff all over their charts. That's a retail's quagmire. All right, so we came back over to the gap here. I didn't want to see that, so we're not in any position of expecting a directional run yet. $9.51, so we're inside the macro. Touch the fair value gap there once more. While we're waiting for that 10 o'clock number, I'm going to do the same thing here that I did here, so that way you can take notes as well on this. This is where we settled on Wednesday on day session, and this level here is the opening price yesterday. So the difference between that is your opening range gap. Okay, and you can run quadrants on that as well, but we're not needing to do that at the moment. So that way there's two frames of reference there, and they're very specific elements and ranges. One's an inefficiency as a gap, one's an actual traveling from an opening price at 9:30 to whatever the extreme high or low is. In other words, if it opens at 9:30 and starts trading up, the highest high formed at 10 o'clock to the 9:30 opening, that is your opening range. If it opens at 9:30 and trades down, the lowest low it forms at 10 a.m. to the 9:30 opening, that is your opening range gap. I'm sorry, that's your opening range rather. The gap is the actual difference between previous regular trading day session hours. That's determined down here. You're going to be using that. Okay. You get the settlement price on that, and then where you open at 9:30, first tick, first print, and then that's your opening range gap, because there's no trading when you're looking at like that perspective, and I'll show you what I mean. This is where we're trading here, and we started trading at 9:30 there. So that opening price right there is the first trade, first print on that down close candle. Watch how the chart changes. See the gap? That's that opening candle here. Let me take this vertical line off. It's not helping me. I use it just to frame a local point for matching all these lines up to annotate so that we can follow along. But this right here, that closing price would be called the opening range gap high, because that's yesterday's regular session settlement price. And then where we opened down here, that would be your opening range gap low, because it's lower than the previous day's settlement price. But I'm not including it here because I wanted to go through it this way and annotate it and audibly talk about it. But if I add those levels, it's just going to be it's going to be harder for you to follow along for what I had in the charts here. So you can clearly see how fast this can become a nightmare for managing levels and referring to certain things. But having them on a notepad next to you keeps everything nice and organized, and when price is trading above it, above what? Any one of these particular levels. And remember, you're going to have some levels from the previous day and the previous day. So you're managing a whole lot of levels that when they match with time and the market structure, what it's implying, and if you have a narrative, what it's likely to do. As I mentioned yesterday, my interest is I want to see it get down to the opening range gap high. That was what I was wanting to see, some kind of an attempt to do that, and even trade higher after that. As I said, I mean, we talked about it on Tuesday, how the market's likely to go higher. We looked at it on the daily chart, but that doesn't mean get in any old time intraday. You got to have some kind of a frame of reference. Let's go back to electronic trading hours. This is a very busy week, and yesterday was like everything coming together all at one time. I have both my nieces living with me. One's getting ready to go off to college next week, and we have a lot of things going on. And the younger one, my wife and I are in the process of getting custody of her, so that way she can be enrolled in school. And it's just so many things all at one time. Yesterday was just, I should have said, no, I'm not going to live stream. That's what I should have done. But you'll see that the things I mentioned on Tuesday's live session, where it's just one-sided and doesn't have much of a fluctuation in price up and down, I prefer not to trade in those days. I mean, obviously, if I'm in it, I'm going to try to maximize and milk it, okay? But there isn't anything I can do once we start looking at the marketplace, and the 8:30 news driver had already passed for like an hour. So, and I don't expect Caleb to know how to trade those reports. In fact, I've told him to avoid them. Wait until after those reports hit the market. Let's look at a 60-minute chart. This was yesterday's trading, 7 a.m., all one-sided, okay? This is exactly what I'm referring to on Tuesday's lecture. Very, 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 very difficult for a new trader to see how to navigate that. And to avoid the inevitable, if you try to always chase it or engage those days, you don't know how far it's going to retrace. You don't know if it's going to retrace. You don't know how far they're going to keep pressing it higher or lower if it's going the other direction. So when it's like this is exactly what I was referring to on Tuesday. It's better for me to try to just sit still, because Caleb's not going to know how to do what I'm going to show tonight. You can see the executions. You can see where I'm getting in. It was very close to the high, not the high of the day, but the high in the lunch hour. Get me go into the PM session. During the lunch hour, which is classically a 2-hour period. So when I say lunch hour, it's not just 60 minutes. It's 11:30 a.m. Eastern Time. This is the stuff you write down in your notes, by the way. 11:30 a.m. Eastern Standard Time to 1:30 p.m. Eastern Standard Time. So whenever there's a run higher, whether it's protracted in one big move like this with no or little retracements, or if it's staggered, it goes up a little bit, comes down a little bit, but this keeps going up into the lunch hour of 11:30, it's reasonable to anticipate a measure of retracement. So identify the easiest relative equal low or single low in the run up after 10 a.m. That has to be after 10 a.m. So you're not really always looking for something before 10 a.m. So 10 a.m. or later, whatever relative equal lows or singular low, the lunch macro will reprice back to that, even if it wants to go higher. Don't take my word for it. Go back through your charts. You'll see it's there every single day. And then reverse that same logic. And if you didn't catch it, you can rewind it when you watch the recording. Those elements is just simply reversed. If the market has dropped, whether it's staggered and where it goes up, down, but just keeps making lower lows into 11:30. At 11:30, start hunting setups that would take us up to the short-term high or relative equal highs that formed after 10 a.m. And that's the lunch macro. Okay, it'll retrace back to that to a minimum. There's other little subtleties that I'll add into the book, but that's enough because a lot of people don't understand what the lunch macro is. So I've now taught that to you. But there are other ones that you can use to capture larger retracements or reversal days, and or where you pyramid and make it a bigger position. But yeah, this is just one directional movement, and I would rather not try to participate in that teaching my son, but just to put my thumb in the eye of everybody that was in other people's live streamers saying, man, ICT really blew it. It was painful watching that. You have no idea what I was managing. I was managing 3 people texting me and looking at the clock saying, okay, I'm going to wait for this and wait for that. And plus it's a one-way ride on the upside. So if I'm aiming to teach my son, I'm not trying to get him in on a day like this. This is the stuff that is going to hurt him, but it's the thing that attracts everybody. That's the flame. And if you're a moth and you want to try to fly real close to that, you're asking for it. All right, so here it is, 10 o'clock. We have really just a big block of short-term highs and lows. So we're running the relative equal highs. If you don't mind, I'm going to take this off now. You've been shown what that is now. If you watch yesterday's recording, it's not a long one, it's rather short, but there are small little fluctuations in there that were referred to as key points to see watching where price would draw to, how to react off of them. And when we do live streams next week, I'm going to be talking a little bit more about entries, not for the sake of Caleb pressing the demo entry, not to inspire him to trade for a combine yet. It's to get him thinking about how to, well, if we know where the market could potentially draw to, and then now what should we be looking for practicing tape reading, like how to look at certain elements of price action and determine whether or not there's something there that would present a catalyst for price moving higher or lower. And once we go through next week, the following week will be things that are predominantly focusing on barriers to where the market may struggle, where the market may have difficulty passing through, and what would cause a deeper retracement on an underlying directional bias or a draw on liquidity. So it'll help you frame this form of normalcy that doesn't feel normal when you're in a trade, especially if it's one with real money. Any tiny little retracement against your underlying position, if you don't have a lot of experience, if you haven't been doing it very long, or if you're trading with over leveraged size, like you're doing the maximum that you can afford, not that you should be able to afford that much, but if you're panicky or if you're anxious about every tick that goes against you, or if it stalls a little bit and stops moving in your favor, but it has moved in your favor and you have open profit, that sensation of, oh, please let this thing just get me out of it. Like, I want to get out of it. It's very exhausting. So knowing what to look for and anticipate that, and that way when you're watching price action, those are the things you want to annotate in your chart after the fact or as they happen. So you want to fill in those gaps of just between screenshots for your journal. You want to really record your observations of what it felt like for you. I mean, if it was very hard for you to trust that a move was going to pan out based on something you see in the chart, the quickest way for you to desensitize yourself to that is to annotate it, screenshot it, and record it. Because what you'll see is you're referring back to something that many times that you started believing or had a concern about that was outside of what was taught. So you're just bringing in your own irrational fear. You're not looking at things objectively, and it's your infancy or your inexperience that's leading you by emotion and fear. So that'll be 2 weeks from now. So we'll talk about those, and then that should finish our month of August, and then we can go into actual entry, like what it looks like to put orders in. So what we're seeing is it's retracing back into previous days trading. So the difference between where we opened here and where we settled here, that is your opening range gap. Okay, so it would look like this. For those of you who watched me do this before in live streams and recordings, that's your opening range gap. Okay, so we're trading up into that off of previous day's opening range high. Now, opening range for today is this low up to that candle's high right there. That's opening range. So that would look like this by contrast. Give me a sec. Okay, that's the time and that's the high. Okay, so it's the low up to the highest high inside of the time measurement of 9:30 opening to 10. See the bottom of the chart, 10 a.m. And the highest high and the lowest low is what you're marking there, low and high. So this is your opening range, and your opening range gap is that opening price here at 9:30 to previous day's regular session settlement price. That's the close. You get that by the RTH, that's the regular trading hours. That's what you're using that information for. But because I already know these ranges, they're next to me, like I'm looking at them, I didn't want to draw everything out because it's too many things on the chart. And I know some of you are you're highly critical, you're impatient, and you're going to look at it and it's going to be confusing to you. And you're like, okay, I don't know what I'm doing here, and this stuff doesn't work. I'm going to go watch somebody else. And if that's how you feel, I really want you to do that. Like I don't want anybody here that has that mentality, because frankly, you don't deserve to learn it. Oh, listen to him. You'll see, or maybe you won't. So we have relative equal highs at the opening. We swept that into just about the opening range gap high. So these two highs here, relative equal highs, lower to the right than the one to the left, trading up into that gap here. drop back into electronic trading hours. Notice that you don't see any of that information here. Like, how do you frame that? You have to use the regular trading hours to see it. It's just a way of determining this is what you have to have. Now, if, let's say, for instance, you didn't have this function down here, electronic trading hours and regular trading hours, because for some platforms, it's not available. It wasn't available. It wasn't anything that people would be able to toggle to, okay? But understanding that element of time, because it's time, then price, you would have those levels on your chart anyway. So this here, this line here that I just annotated with the regular trading hours for previous regular session trading settlement price goes all the way back over to the previous day and where we settled, 415. So it's a matter of managing what you're looking for, what makes a key level key, what time is important, what are you trying to derive from that time that makes that level key. So all those things are the beginning building blocks, Caleb, for you to determine your obvious draw on liquidity. That means the thing that's so overwhelmingly obvious. When it's like that, that's when you're anticipating a price run. That's when you would eventually push a demo button. That's when you would eventually press a button that would contribute to a trade for your funded account combine. And then eventually, when you get funded, what you're focusing on to take a trade with that funded account. And then eventually get to the point where you can take out a withdrawal, and there it is. You take out money, you fund your live account with a real brokerage firm, leave the funded account entirely, and then you've done it on your own. That's what that expects. That's what I want. That's what I'm aiming for. I'll take that off because I don't need it. And we have end dog, new day opening gap. So we just saw. Let me put it back on here. That's the previous settlement price, but it can wick through that. So if it's going to wick through that, it could go right up into new day opening gap because it's just above that. You see that? Which is the reason why you have to have these levels either in a notepad, referring back to them periodically throughout the morning or the afternoon session while you're watching price, anticipating certain elements, measuring whether or not it has the ability to maintain once it books to these levels, or does it want to just keep powering through? And if it just rips through them all, then you got to go out to a higher time frame, 15, 60 minute, 4 hour daily. What is it reaching for? What is it reaching for? So there's an old daily high we talked about on Tuesday. If you watch that, you know what I'm referring to. I'm not going to do it here. But it's not necessary for that to be there, because if it's like this and it has the end dog right there, then I'm just going to observe and study the end dog. It doesn't need to touch it, but if it goes above previous settlement price, it's going to reach to that, which is, we're basically stating the same thing. It's just going to go up just to another level here. I'm going to be with you all until 11:30 today, so no hurry for anything. Very sloppy morning so far. Now, when you say that, ICT, what do you mean when you say it's sloppy or unorganized? Usually when I'm saying it's either disorganized, it's unorganized, or it's sloppy, meaning that it's really not showing a great deal of conviction one way or the other. Even though there's movement, I'm not gonna argue and say there isn't price movement here. There isn't anything clean that's so overwhelmingly obvious, which is the whole point of me doing these lectures for Caleb. You're benefiting from seeing the stark contrast between when you'll hear me say this is really clean price action, And then when I do that, or in this case, when I say this is very unorganized, or it's disorganized, or it's sloppy, you want to take a screenshot of this. And the things I'm about to refer to, that kind of differentiates it between that being something that is not a very easy navigation where you can get in, clearly see what it wants to react off of, and then immediately run away from that, go to a specific level that's so obvious in the chart. You have so many things here that are conflicting. So if I have a barrel or a bucket of apples, okay, and I reach into that bucket of apples, and then my sons each grab an apple, and we all throw the apple up in the air. And I tell my wife, grab an apple. Which apple? Or impulsively, just going to grab any one of them. Okay? But what happens if one of those apples are a Granny Smith? They're green. And then all the other ones are just a regular red one. So if I say, when we throw these apples up, you can't open your eyes up until I say open your eyes after we've done released them in the air. But your job is to only reach and grab the green apple. We all throw the apples up in the air, and then I say open your eyes. And then my wife opens her eyes up, and the first thing she's going to go to is look at all these look at all these red apples, and then let's find the green. Or she's going to see the green one, but her eyes are going to jump to the other red ones. So what do you have there? It's chaff. You have things that are drawing your attention that aren't obvious versus, okay, close your eyes. I'm going to take the singular green apple. I'm going to pick it up, and when I throw it up in the air in front of you, I want you to open your eyes and catch it. You see how easy that is? That's the benefit of looking at price action that's clean. It's very, very clean. There's only a few elements that are in the present price action. Not that there is that characteristic right now. That's not what I'm saying. I'm saying by contrast, when you have a lot of this in here, okay, back and forth like that, there are levels that I've shown you here that it's respecting. It's drawing to the levels that we have here. But is it obvious which one it wants to respect next and where it's going to go to next? That's what's missing right now. It may clear up once we get through the first 30 minutes of 10 o'clock hour. So post 10:30, we might get something entirely different in terms of the delivery of price. But right now, nothing in here is terribly exciting. Whether you made money or not, if you've lost, that's the reason why. If you made money, I wouldn't build too much around that. We did, in fact, trade down to 20% of the weekly range when we traded here, which overlapped with the upper quadrant of yesterday's opening range. So when there's a confluence of those types of levels, what happens if you have the previous 2 days ago opening range or opening range gap level in addition to one or two of these elements here, and there's a PD array, and it's happening to form in a macro time, first 10 minutes before the top of the hour to 10 minutes after the top of the hour, then you probably have a really, really good reaction coming. So then all you have to know at that time is, where is the smooth area in price? Where is it likely to draw to on the very short term? And that's the building blocks of reading and tape reading price. Not for setups, but to build this rapport between watching candlesticks form, removing the concern about the chaos that you're watching and thinking, how am I going to be able to read this? How am I going to be able to determine this? You're just looking for the obvious. And if it's a lot of filtering on your part to do that, you're going to see, not in the beginning, because there's going to be days where, like for instance, like yesterday, okay, I had people watching me. I'm quite certain that they were like, man, why isn't he part of this? Why he doing this and why he doing that? You're forgetting that I'm trying to teach my son how to go in and look for easy, obvious setups that his skill level, that's what he's supposed to be focusing on now. Not me getting out here and just trying to impress people. That's not what this is. You'll be impressed in a little while, a couple months. But right now, we're just focusing on what my son needs to focus on. And you're just being invited to watch. And some of you don't deserve to be here. So here we have what I was referring to. It's a lot of back and forth, back and forth, back and forth. But what is it working off of? The previous opening range high. See that? Down into 20% of the weekly range. Rallied. Come back down in. Rallied at 9:30. Trades back down in. Touching one more time, opening range high. Once more here. Relative equal highs. Everything's jagged here. Trades back up into today's opening range gap that I highlighted and showed you, but is not annotated on the chart here. And the draw up into the new day opening gap, which it can sweep through. We do have relative equal highs. Notice that right here. See that? So there's a little bit of liquidity there. And with all of this action here, the only thing that really stands out is that volume imbalance, which we just traded to on that candle. And my eyes, I don't trust it. I don't think that one touched it again, but right in here. So we could see it potentially expand up and engage the liquidity right there. So you can have your chart look like this. And these are all the simple things that you're doing while learning how to read where price is going to go. Because if you don't have this part of it down, nothing anybody tells you in terms of buying and selling, what indicators buy and sell, none of that stuff's going to help. You have to know with practice, it could potentially trade to this level. For what reason? Real orders that are resting in the marketplace. What I would have liked to see, I would have liked to see it keep the gap open like we had yesterday, run lower for a little while, down into the consequent encroachment. And had it gone down here, this is the actual level I was going to point your attention to there. Because it would have been like, here's consolidation, drop, and then drop once more. So that'd be second stage distribution. And then down here would be smart money reversal, then something low risk buy, accumulation, reaccumulation, and then send us up into that. So that'd be a market maker buy model. But we had this, this business in here. Back into new day opening gap for today. I saw a few people leave comments yesterday about the volume, and my advice is to listen to it through headphones, because I can hear it fine, and I don't need the volume all the way up. So I mean, if you're working in a Jiffy Lube and you hear the impact wrench constantly behind you, or hear your surrounding noise at your workplace, I can't fix that for you. Get yourself some headphones. All right, so we have institutional order flow entry drill there, the wick over top of new day opening gap. So study that, Caleb, and see if it wants to send price from what we just seen here, leaving this portion open, and see if it can push up in there and engage that liquidity there. When you're watching this, observations, things that you're looking at, every time you do a measurement on delivery, what does that mean? Like what I just outlined there. If we're looking at something that might be a catalyst for price to react off of, and where it may reach to. You're not trying to be right. You're not trying to nail it down to the very perfect turning point. You're just trying to recognize, just like when someone takes you hunting. You've never been hunting before. Well, how do you track? Well, they take you out to the snow or in the mud, and they'll say, look down here. You see that? And you'll see a footprint. You don't know what you're looking at sometimes. But the person that understands it will say, yeah, this is a raccoon footprint. This is a bear footprint. This is a deer hoof. It's teaching you initially, this is what it looks like. So that way, every time we pass one, I'll point that out to you. Because you start seeing it being pointed out to you, you recognize it. Certain characteristics repeat. Not all of them are going to look identical. But every single time you do it, you're getting another measurement of increased understanding because you're being exposed to it. So when you have a observation, and it doesn't have to be the ones I point out, whenever you're looking for price to behave a certain way, or you think it might behave a certain way, you want to write down the time you observed it, and the time it took to either trade where you thought it was or completely close over. Now, the observation I pointed out here, buy side about sell side efficiency, in that one single little candle, we're studying to see if this gap stays open. Any small little portion of it is all it's referred to. It's better for it not to completely close down to that. It can, but it's better if it doesn't. For what purpose? To leave some of that open and then explore whether or not they want to take this liquidity. They don't have to. It doesn't have to be traded to right now. But every time you do this, you're getting a measurement on price delivery. So you want to see how much time it takes from your point of identifying it, how fast it runs in your favor or how fast it runs against you, and then how much time it took to deliver where you thought it was going to go. And what that does, it gives you a baseline of how many observations are you seeing each session. And in the beginning, you're not going to see very many of them, Caleb. You don't know what you're looking for. But because of natural progression of just simply doing it over and over and over again each day, not trying to press the button, not trying to be right, you're not trying to be profitable in your observations, you're trying to build a recognition. And repetition builds that recognition. You can't recognize the setups until you look for them. And don't be afraid of doing it wrong. Looking at observations and price and measuring all of these data points will give you a baseline, and you will see progress based on that. Because in your journal, every day when you're done, you want to have a little tally of how many opportunities that you watched real time. How many times did you do a measurement on price delivery? And again, in the beginning, you're not going to have very many of them. And that's not a bad thing. It's not a knock against you. It's not some kind of a concern. But it's a baseline beginning point. And in weeks from now, you'll start seeing maybe 3 or 4 each session. And then by the end of the year, you'll probably see all kinds of them. And then what that does is when you have a collection of a dozen or so that you can see real time forming, you're going to see, because of experience, the things that you don't have yet right now, that you haven't really focused on, or hasn't been made apparent to you, that are more critical to your understanding than the things that you're holding on to right now. You're thinking certain things are much more important, and you're constantly looking to satisfy those concerns versus just simply letting go of the necessity of being right or wrong. Forget that. That's not what this stage of your development's about. It's for you to simply look at price, observe elements and characteristics that tend to do certain things. And if it's likely to do these types of things, how often can you observe them without being prodded and pointed to, saying, watch this thing right here. And if you keep record of how many you're doing each time, the experience factor will kick in, and you will have it won't feel like you've gained much understanding at all, because you won't be pushing buttons and trading with money yet, not even in a demo. But you'll be observing that your ability, the skill set of finding the opportunity of seeing when price should start at one place and travel to the next. That's navigating price action. That's you understanding how price has the likelihood, not guarantee, the likelihood of performing a certain delivery and price, higher or lower. And because you have no baseline to start with to determine how far along you should measure your progress, you have to start somewhere, right? And by having a documentation of how many observations that you're recognizing while watching price action, just simply tape reading. And then weeks from now, when it won't technically feel like you've gained much of an understanding, which is what most of my students feel like because they're impatient. And the way you stem and stave off that impatience factor is that you're measuring your opportunities that you can observe in real-time price action without any kind of help or prodding, and removing the element of I have to be right to impress dad, or I have to be right every single day, or it's failure. That's not how you're doing it. Okay, you're looking at how you will be able to measure with data how many opportunities are available and that you have available by your own skill set that will increase as you go further along, each time making a little bit more deposit in your understanding. And then when you see the data, even if it doesn't feel like you've gained much in terms of experience or understanding, when you start looking at your first week of doing it and say, well, I couldn't see much at all, dad had to point it all out. And then a couple weeks after that, you're like, oh, I can see 1 or 2 each session, but I had 5 wrong, but I saw 2 of them that were right. Don't look at the 5 you had wrong and say, I'm failing. Look at the 2 you did right. What is there that you saw? Because that is your very first multiplier. That's your PD array. That's the thing that your eye is seeing. The other ones may be used to simply forcing because either impatience or you just didn't see it. And that's okay. There's going to be moves that's going to move without you. It's not a big deal. But you correctly manage your expectations and the assumptions of what your progress should be or shouldn't be at that time. And you can't argue with the data that says this is where you started and you had next to 0 opportunities that you identified without help. Then 1 or 2, but a lot of them you didn't see pan out. And then what will happen is that margin and difference between the ones that you thought were going to pan out and the ones that did pan out, they'll start equalizing. They'll be half and half. That's progress. It doesn't feel like progress. Anyone looking outside that wants to be critical, they'll say, you suck, you can't do everything, or you're looking at losers still. Like they don't take losers. Okay, I take losing trades. You've seen that. I can do it wrong. And you have to give yourself the ability to be flexible in the beginning, especially in the beginning, not to have all of this, I have to be right. I have to do it correctly each time. Because if you have that's going to stunt your growth. And it's going to cause you to have a whole lot more doubt every time you do it. And you don't seek a gold medal every time you do it. You're not looking for that. You're looking for measured progress. And the only way you get that is by keeping data on how many opportunities you study. And guess what? If you're not going to study the chart and watch it real time, you're going to have 0. And then you have no progress, right? So that's what happens when I have students that come to me and they'll say, I've been watching your stuff. I've been studying your stuff. I look at your stuff and I can't make it work. Okay, well, how are you back testing? Show me your back testing. Show me your log. Show me your journal. Well, it's crickets because they know they have nothing to bring forward to say, here's the proof I went through it. Not 5 pages of scribble that was just done just to say, well, here's our argument. That's not valid. That's not a valid argument. You have to be months of this, and you're studying how many observations you looked for this certain thing to pan out in price. And does it pan out? How long did it take? What time did it start? What time did it end? And then by doing that, you'll be able to look at the data and say, this is how many times I started learning this and I couldn't find it. Then progress over a couple of weeks. Then I was able to find some, but I was still picking them wrong. And then a month later, you'll have the beginning stages of equalization where you have half and half, where you'll still see some that work and others that don't. That's a really good mile marker for your progress. And then what happens is after that, the times that you do it incorrectly, they don't pan out for you, they will diminish and you'll have better, correct price delivery measurements of every time you see price behaving a certain way, it should do this and not do that. Run here, but don't go here. And see how long it takes for those things to pan out. By looking at the progress that you have, doing it that way, you have something that's statistically measured against a baseline starting point. Whereas if you don't start doing it and you're not consistently trying to do it each day, you won't have progress, you won't have experience building in you, and you won't be able to reassure yourself and encourage yourself because the data will support that you are indeed getting better at it. Even though emotionally and psychologically, and the fact that you haven't made money trading yet, because that's what everybody wants. That's the real report card. Am I able to make money with it? Well, it's unrealistic for you to expect that you're going to make real money with it in the first 6 months. I've been very obvious and forthright with that. I've never made any kind of argument against anything less than. If you've done any kind of study at all and it's less than 6 months, I'm not surprised if you don't find success in it, monetarily, money-wise, making money, because you don't know enough. You haven't done enough exploration in your own observations. What are you doing wrong? Because that's the benefit of having price delivery measurements where you're looking at, this is what I think price is going to do right now. And you're doing it in the privacy of your own chart. You're not talking about it on social media. You're not trying to share it. Okay? You're simply just saying, this is what I'm trying to do. I'm observing price right now, and I want to see, does it behave this way or not? And if it doesn't, wonderful, because I can go in and I can study, what did I see wrong? What did I do wrong there? Do not say, well, that one didn't work, I'll pretend it never happened because, I didn't push the button, so it doesn't make a difference. That's the wrong perspective. Wrong perspective, okay? You want to be able to see where you did it wrong because that's where your best learning is going to come from. Obviously, if you do it right, you want to champion that in your journal. Say, I feel really good that I was able to see this one. But I missed on these. These didn't perform as much as I thought they would, but this is my takeaway from it. I didn't notice this or that. This was my indication that it wasn't going to pan out. And now that I can see it, I have this information and new experience to lean on the next time. You hear what I just did there? You're not putting blinders on saying, oh, I didn't do it wrong. Or if you did it wrong, say, I ain't worried about that. Like people do with demo accounts. They'll open a demo account and press, and they'll show the 20 trades that they have in gold where they're doing 50 lots, where they don't even have the money to trade with 50 lots, and there's 20 of them, okay? And this was before everybody was doing the 20 funded account, linking them together. It's just everybody thought that was everybody's success or not. And they're all within 2 or 3 ticks of the same price. So they're just going in there just buying, because they want to see a screen to show on social media where all these trades are making $6,000, $8,000, $10,000 a piece. They're absolutely, I'm going to tell you something. People that make that kind of money are not rushing to social media to show that they're doing that. They don't care. They're living their life and they're doing well. So you don't want to have that inspiration to draw your attention to what is working only and avoiding or ignoring the times when it doesn't work. You want to focus on what you're doing wrong at that time. Perfect example right here. Here's your fair value gap. That's where your stop would have been. Hypothetically, it's not a trade. That would have closed it right there. So it left relative equal highs. It started with this candle right there. So your time would be 10:22. It moved to 10:31. So it moved 9 minutes in favor. In other words, it moved in the right direction. Wasn't able to get above this high here. And then at 10:37, it would have stopped out on that trade. So that way you can record that. So now you have one piece of data, one data point. Say if this is your first one, you would record that. So right away you actually have a very humble beginning. The first one you start with didn't pan out. That's wonderful. But if you don't have the right perspective in trying to learn, you look at that and think, well, this is very disenchanting. I'm not real encouraged by this. And that's the same thing that happens when people get their live account or they pass their funded account. They're paralyzed because they don't want to take that first trade. Now we have this. We have relative equal lows taken here. Relative equal highs here. And relative equal highs here. Where is it jagged? Here. What are we trading into now? New day opening gap. So now we can look at it as an observation here. Do we or can we see it trade above new day opening gap and then come back down and touch it? If it does, then we can measure that. That's another time delivery measurement where we can simply study what price does with the expectation that does it want to trade above here and gravitate back to here. We're not thinking about, well, if I would have had 15 contracts on here because my funded account company says I can trade with 15 contracts, and I would have lost on 15 contracts being stopped out right there. That's not what you're doing. You're looking at, can you see what price is likely to do? And these are what the opportunities look like. You can start just simple things like this. This is so much better and more profitable for your learning than just going in and pushing a button or chasing what price has already been doing and just trying to get something to happen, because you want to be inspired by that fake profit. You want to be inspired by the screenshots of showing that you made XYZ amount of money, but you don't even know why you got in that trade. That has to be something you can observe and repeat. And this is the boring stuff that feels like you're spinning your wheels. It feels like failing. It feels like you're not doing something productive because you're not even entering any orders. But this is exactly what you do. And you spend time watching price like this. And on really nice days, it's fun. On days that, like we're having here, it's a lot of give and take, back and forth price action. And price isn't as clean. Whereas if you looked at this run in here, we only have this gap and that gap. Everything else, watch what happens. We have this run here, and then it trades back down, creating that first fair value gap. Then the next candle, we trade down a little bit and then run above. So this previous candle has a lot of that range overlapped here. Back and forth inside that range. Now we're working off of this gap, which became what? Inversion fair value gap. And it rallies. You could have used this one, because I was jawboning about something else. You could have used this one as a measurement to see if it can trade to the new day opening gap from here to there. And you time, okay, from here to there, how many candles did it take on a 1 minute chart? So that's how much time it took. Was there any heat on the move? Okay, how much movement away once we left, see the bodies, once we left it, did it ever come back down to take that low out there? Not before taking the run into that new day opening gap. And by observing these things, and don't be afraid to do it after the fact. Like if you have no ability to watch it live, go back in and, like for instance, I was expecting to have my son sit next to me yesterday too. So that was another thing that I was irritated by because he had to work. So his job changed his schedule on him, and we usually are able to, sit side by side on Thursdays. And I didn't have that opportunity, so I was a little perturbed by that. It was irritating me, and I had a lot of other things on my mind at the time, and a very abbreviated time that I could spend with you because I had to be off by 10:30, which I noted at the beginning of the recording yesterday. It wasn't me saying, "Oh, I'm going to rage quit and say I can't do nothing today." It was already predetermined before we even got into it. All right, so now let's play devil's advocate for a moment. Let's say you did an observation on this one here, and you try to use institutional order financial drill. I want to see if I can get anything off of that PD array. It rallies a little bit. Could you have taken, on this one here, could you have taken 10 handles out of that run? Yeah. Could you have gotten 20? Probably not. 15? Yeah. So if you're going to be doing these examples, what is your threshold? What are you trying to do? Well, if it's ES, you're looking for 5 handles. If you can get 5 handles and hypothetically say, okay, I'm satisfied with that, I would be done. And that would be your observation. That's your measurement. That one would be done. And then if it's NASDAQ, you want to have at least 10 handles. 10 handles, I prefer 15 personally, because that kind of forces you to look for a range that affords you 20 points or 20 handles from where you think it's going to react to where it's going to draw to. So if you can get 20 handles out of it, it's reasonable to anticipate being able to capture 15. That's my personal filter. Like if I can see 20, I know I got a good chance of getting 10 minimum, or 15, which is like it's a typical second partial. And then if it can run the 20, great. If it doesn't, I don't care. because there's always some kind of an opportunity where the stop loss can be moved to where it's not a losing trade per se. It covers costs, covers commissions, and gives me pizza money or whatever. But you need to have a threshold of what you're looking for. So don't demand also that it is a setup that has to pan out to the target, meaning this, where we were watching this fair value gap and this right here, that candle, that would be institutional order for entry drill. Why? Because it just goes below these candles here, but doesn't close that gap in. So that would be your marker to start it. And if it can go run 10 handles, boom, you're out. And it need not trade above the relative equal highs, which would have been the draw to see if we can get that type of run. We did another one in here. We watched and see, did it go above the new day opening gap and touch it? It didn't do that. It went above it with a spike with that wick, but has not created a candle that come back down to touch it. So the second one that we're anticipating and studying has not came to fruition. Here we have a fair value gap there. And now we have this inversion fair value gap. So you want to study, does this fair value gap get taken to the upside? If it does, if it comes back down and touches it again, we can treat that as an inversion fair value gap like it did here. There, then sent it higher. So this gap in here, study that to see if it acts as an inversion fair value gap, or does it respect it here to drop back down into that gap again? You're not trying to be right. You're trying to recognize a pattern that makes sense, because there's all kinds of ways to trade. You can be a perpetual bull like I was when I first started, or you can be someone that's going to be flexible, that you can say, I can be a buyer and a seller. But you also don't know what you're comfortable with. You don't know if you're trying to capture a continuation trade. You don't know if you're trying to capture a reversal. And I'm trying not to push that on you. Because if I push that on you, that means I'm pushing you into a mold. And it's going to cause you to take a whole lot more time trying to live up to that mold versus you organically trying to learn how to read price on your own. Watch the wick right here. Watch to see if it can touch that. Does it react off that and drop right into here? We have two gaps in here. We have this one, which is trading up into here, and then we have this one here. This is a normal fair value gap, bearish fair value gap. This is an inversion fair value gap where it's gone below it. Now, let me draw it out. See it? And then we have inside that one, we have this small one there, which is just a standard bearish fair value gap. Excuse me. And if you look right here, I was taking your attention to this wick. Trading up into that, we want to see, does it have an ability to trade down into this old gap here? Okay, so you would screenshot that right there. So what we had is inversion fair value gap here, and then a bearish fair value gap. That is a very, very nice model when you have a directional bias that leads to that directional run. We have a bearish order block, that candle here, because it had the highest up close versus this one. Don't look at this and think that that's the bearish order block. It's this one. It's inside of the fair value gap here. and it also traded into the inversion fair value gap there. The key is watching this wick trade up into it here. If it's bearish, what would it do? More specifically, what would it not do? It would not touch the midpoint of that gap or wick, which is what we have right here. See that? Trades up, but doesn't touch the midpoint. So is that weak or strong? Weak. So next candle, you can open. If it trades up, volume imbalance, that could be an entry to here. See that? So all these little observations, this is what you're doing while you're watching price. You probably have been, if you're the other people, that it's not my son I'm referring to now, other students or casual viewers or people that listen to say, you know, it's tape read. What is tape reading? This is tape reading. These are the things that you do while you're watching price. You should not be watching live streamers if you don't know how to trade. If you know how to trade, then sure, you know, watch them and enjoy watching it. But you're literally wasting your time. If you're not watching my videos to learn these types of things and that you want to put them to work yourself, then you're wasting your time. You're not going to learn it by watching my videos, okay? I promise you. I don't care how many times you watch them, you're not going to know how to do it because you don't know what you're doing because you haven't done any lab work. You haven't gone in there and put yourself in front of the charts and tested the things and looked for it because you don't want to see it fail or you're afraid it's going to fail, so you don't even bother to do it. It's like you let everything else around you influence you, and it keeps you from doing the very work. And this is the work. This is the stuff that you're supposed to be doing. This is probably more money than you ever made in a trade if you would have took it with real money. And it's because it's something that you don't want to do it. That's all. It's just laziness. If you believe other people's opinions about me or whatever I teach, well, then why are you watching the videos? Why bother? Because you're waiting for something to make it real easy. That's why. And this is the part that makes it easy. You got to be in the charts. You got to be in there doing it. Trade down into this inefficiency here. Getting reaction back up. And if we overtake this inversion fair value gap, this could become a reclaimed bullish fair value gap. But it would have to trade above it, come back down and touch it, and then we can look for here and here. But then you're waiting. Okay. So it's a matter of simply looking for certain things that could, you don't need them to, you don't demand that they do, but they could deliver a certain response in price that can be reasonably expected. But you want to start with the lowest threshold of what you're aiming for, what you're trying to do. Well, this candle into that wick right there to here, that's 10 handles. And that's a real easy low threshold observation. And then what you do is when you see this, Caleb, you say, okay, now if this would have been a trade that you would have trusted because it becomes part of your model, because something that you have seen enough examples of that I know that it could potentially trade at these levels here. But what happens if I'm on side and it gives me just a little bit more juice out of that lemon? Well, then you use this as a partial and you aim for something in this price run over here. I was talking about this, I don't know if it was yesterday now, but I was talking about the market maker buy and sell models. And when you're trading inside the range, you look for all the short-term lows in here, anything singular or relatively equal, and or any inefficiency. And that's what you have here. And the market trades down into it on that run. So you can take this, and that would be a terminus for you. Any one of these levels, the top, consequent encouragement, or the low. Which one's the easiest one to get to? The high. So that's the one you use, Caleb. You don't demand that it goes halfway. You don't demand that it goes all the way to the low. You don't demand that it trades through it. You simply just look for the easiest threshold of being profitable if it were a trade that you were in. And if you start like that and you just let it build up and build up and build up, look at that response right off of the bottom of that with the bodies. That's pretty. The It's also, again, tapping into that gap in here. Let me draw it with the lines, that way it stays visual. Okay. That's the wrong color. I apologize if that's throwing you off. I just wanted to highlight it because that was a gap. I'll just keep it like this. It's been used already, so it's dimmed out a little bit. So now we're below that old gap. Remember this one over here? Here. Let's see if it wants to touch that one more time. And does it react off that and make an attempt to go below this low? Or does it trade back above it and treat it as support and then rally back and engage this area as well? Now, if you haven't already thought about this, and since we're watching a 1 minute chart, there will be a time in the future that you'll be able to sit down in this time frame and capture 10 or 15 handles going up, 10 or 15 handles going down, 10 or 15 handles going up, maybe lose on one or two, catch 10 or 15 handles going down, maybe lose one more, 10 or 15 handles up, 10 or 15 handles up, 10 or 15 handles lost, 10 or 15 handles lost. Not that you lose that much, but you have the ability to trade 5, 6, 8, maybe 10 times in a day. And on a 1 minute time frame, that's not over trading, because there's so many opportunities that you can trade. And then you can be making 100 points, 100 handles in a single day, even if the range doesn't move 100 handles from the highest high and the lowest low. And you want confidence? That's confidence. Because if you can do something like that, any given time where you sit down and say, okay, I don't care about what the volatility is going to be today. It might not be a very large range day. So I'm just going to go in and I'm going to scalp. So I'll look for little tiny little setups that give me fluctuations in price that are reasonable. Put a limit order in at 10 or 15 handles based on the things that we're looking for, and then bang, take it. Then when it's done, move to the sidelines, relax, and wait for another one. It's very fun. But if you look at it like I have to do it, or I want to do lots more than what's reasonable for my skill level, you're inviting all these external stimuli in here. And because the natural progression of going through these things, they're not always immediate feedback that's positive and that tickles you. It doesn't make you always feel good. Because sometimes it's like, okay, I thought I saw something there and it wasn't there. So what do I do now? You go to the next one. You go to the next one. You go to the next one. And you're completely desensitizing yourself to the outcome. If you're afraid to lose, you have to go out and you have to lose. You have to do it wrong. And you don't want to do that with a live account, not even with a $100 account. Not even with a $250 account. I had to learn with the real account. Okay. You learned all the wrong lessons. And now they're going to be problematic to you. And you can lie and tell the public that follow you on your social media account and say, oh, I don't have those problems. Trade live. Do it in front of everybody. And you'll show everybody that you do have those problems. Okay, so to avoid all that stuff is don't have it in the beginning. Don't hold yourself to a standard that you have to have high strike rate. If you just started learning, or if you just now became serious, let's say it that way. If you just started learning how to become serious about studying price, and you are using me as a means of helping you do that, then remind yourself that you don't have to have a high strike rate. That's a hallmark for someone that's been doing it a long, long time. Doing what? Their one model that they trust the most, that they can see it forming every day. What is a model that can form every single day? Like what is a trade set up for life? What would something like that look like? Well, when the market has made a very obvious run to a key level you were anticipating, and then it starts to break down and there's a very clear inefficiency or relative equally low that's in play. And there's time in the day that affords the market to perform and deliver on that basis. That setup, that criteria is there every single day. And you can find it on a 1 minute chart. You can find it on a 30-second chart. You can find it on a 15-second chart. So there is an opportunity for you when you know your model to trade every single day. But it's a mistake. And anyone that pretends to be a mentor that tells you that you should be trying to make money every single day, wrong. That's not a lesson that a new traders should be given. That you're not trying to make money. You don't even know what the hell you're doing. You don't know what you're expecting to see. You have no idea. No idea. And you don't know what the person that's pretending to be a mentor is really trying to communicate. They'll talk about it afterwards. They'll point out the salient points afterwards. It sounds scientific. It sounds intellectual. But it wasn't given beforehand. So is it really foresight? Is it real knowledge? Or is it just sounding smart after it's obvious in the chart? Think about it. There's a TED Talk that I gotta find it now. It just came to mind just now. It's an awesome TED Talk. It is a guy that young guy. He comes out there and he's wearing his glasses and typical nerdy little guy, and he starts talking about nothing really, but it sounds like he's talking about something really engaging, and his mannerisms and his delivery and his tone and his pauses, and then he over accentuates certain aspects of the things he's referring to, and then he goes, now what I just was doing, I was talking and I really said nothing, and then but you seem like you're learning something from me because of what I'm saying, how I'm saying it, and the delivery. And I'm wearing these glasses, and they don't have any glasses in it. Like, he puts his fingers through it. It's a really amazing presentation because it starts off like, wow, what's this young man going to talk about? And it's engaging. And he walks around, he carries himself, his body language, everything. And that's basically what an infomercial does. And the only thing that's important that you notice is the product that they're standing next to. But they're talking and they're bloviating about a lot of stuff, and they're really not doing anything. They're not saying anything. And I've seen that a lot with people that live stream. I've seen that with people that pretend to know what they're doing in teaching, and they don't really teach. They're not really teaching. And you can hear what they're teaching is absolutely backwards, because they'll say you have to trade every day. They'll say every day is a winning day. Every day is a opportunity to trade with real money, or you can't learn how to trade unless you trade with real money. You have to have skin in the race. Well, you know what you've done by doing that? You have further multiplied the level of certainty that it will be harder to learn it, because now you've made a painful response absolutely the outcome, because you're going to trade with real money no matter how much it is, if it's little or not. And you're going to have an outcome that's going to be unfavorable. And then you're going to have the regret of, I wish I never would have did it with live money, because now that small little $25 loss, while it's insignificant, it costs probably more for you to go to eat poison from McDonald's at a drive-thru than to take that $25 loss. But that $25 loss is going to be like a piece of meat between your teeth. You're going to find your tongue keep going back to it, and you wish you had one of those little dental floss things to get it out. And it's going to plague you all day long. And what are you going to want to do about it? You're going to want to fix it, right? So how do you do it? Take another trade. And now that 50 loss on the day is there. And now you're angry. I wish I never would have started with a real account. I wish I would have known what it was I was trying to do. That way I was bored. I see it forming. If it's obvious in the chart, I'll see it. And then you try to fix it again. And now that $150 account that you want to start with real money has 50 bucks in it, not counting commissions. But hey, it's 11 o'clock in the morning. There's plenty of time to get it back. Let's go in there. It's only $100. The $150. Who cares if I lose it? I can just replenish it. That's the wrong mentality. That's the wrong mentality. But that's what goes on. That's what keeps repeating. That's what mentors out there that should not be mentoring foster those mindsets. They enable you to have those same viewpoints. And people pay them. People pay them for that flawed logic. So we have had multiple attempts in here at that old fair value gap. Right there. We're inside it with the bodies. The only thing we've done is worked into a retracement of all this choppy range-bound price action. So if we measure that from here to there, we trade it right down into that, which is equilibrium. So we have had this gap traded to. Didn't quite come down to, I was watching to see if it would touch that. It didn't do it. But now we're above that old gap here. Let's see if we can touch it on the downside. Let me get this fib out of the way because it's given a level that I don't want you to focus on. I want you this. This is what I want you to see. So we have this wick, midpoint of that. I like to see it go over that a little bit and touch this gap and then respond a little bit higher. There's nothing in here for inefficiency. So where we're at, it's indicating that it could use this old reference point over here. Keep the body inside of it. If it keeps the little tail in here, that's fine. I should have grabbed the full water when I brought myself down here. Came down here with a half a bottle of water. I would have liked to seen that candle have the body inside of that gap. That would have been a little bit more obvious than what it did here. Now I want you to think about, actually take a screenshot of this price action as it is right here. Let me make it a little bit better. Like that. Okay. Now, be honest. Looking at this, do you see very clear impulsive legs going up, leaving one singular inefficiency in it, like a fair value gap, maybe one singular short-term low, and then it runs up to an obvious level and then drops down with a nice retracement price swing that has only one singular fair value gap, and then runs away quickly lower to an obvious level to react off of and trade higher? If you don't see that, that's the indication that this is not a day that you keep pushing really hard. And it's also a day that you demand a lot more convictions behind what you're trying to engage. Even if you don't have your model yet, being flexible with it. I like that right there. Watch this candle halfway here. I want to see, does it want to run up, take out that high? If it runs up and takes this high, I would want to see speed take us into this gap. It's the red right there. So this high, it's been taken out. Next reference point is here, which is the old gap, and then we have the liquidity resting right above that high, right there. So I'm not going to keep these lines here. I'm just going to use that line there to annotate a very short-term buy side. I'll take this off. And we'll extend this out. You're not trading it. You're watching it. Man, I don't know how my wife sits in this stupid chair. It looked great in the store. It's a what is it? It's called a love sack. We didn't do anything on it, but I don't love it. I'm literally sliding, like slinking down in it. It's really not that comfortable. The stuff that's on it's comfortable. It's real soft, but it's actually not comfortable at all. Okay, so one more time, wick traveling inside of the old gap over here. A lot of back and forth, but not real movement. I mean, there's movement, yeah, but nothing to be terribly excited about. So think about it like this. It's like it found its way up to here, but it's a lot of back and forth. A lot of back and forth, a lot of back and forth. Can it be traded? Yes, but it's very, very difficult. It's not going to be something that you're going to want to do as this is your model. This isn't your choice ideal day or type of environment. You want something that's really nice and clean. It runs higher, goes to a real clear, obvious level, pulls away from it, and you're not seeing that here. There are inefficiencies here. There are short-term highs and lows here, but you don't have that clear, obvious, it wants to go one side or the other. And by having, like, if you take a picture, I was going to say that earlier, I didn't finish my statement. Take a picture of that, just like it is right here. And this is not a clean market. It's not a clean market. It's a level of difficulty for someone that doesn't have a lot of tools or experience. You can get chopped up. This is usually the type of day where you'll see live streamers or people that are in their chat. They'll say, I got chopped up really bad, or the market just chopped me up, or I just got beat up today. It just was crap market conditions, that type of thing. This is usually indicative of what they're referring to versus days where it's just really, really clear, really, really obvious. All right, so now we had inversion fair value gap traded to here. That gap that we annotated earlier worked inside that as well. One more time, we touched it, traded lower. We have sell side resting right below this low. High was taken here. So there's nothing in here that I like except for the singular one candle that's balanced with here. So we always have this to there. So we have this closing price to that high. Price is going back and forth multiple times there, so that's why you get that stop. That's why I say I want to see it expand through. I want speed through that because this is a balanced price range. There's no speed. We drifted back lower. Now we've shown the bodies respecting that old gap, which is over here. So the next one you can start to monitor is, do we use the wick ret in here in the low of that old gap to make an attempt to run below that low? It's Friday. We've already had a 20% retracement on the week, and we're seeing lethargic price action. Got 15 minutes till the morning session ends, and then we will be entering the lunchtime macro. See how it's going back and forth, aimlessly. It's not trying to do anything. Just do chop back and forth, back and forth. By having that screenshot like this and identifying how this market looks by contrast when the market has, not yesterday. Yesterday is in completely different market environment where it's just one-sided, like a railroad train, like a train just going one direction. You really can't navigate back and forth, up, down, up, down, up, down all day long in that type of environment. It's just get out of the way. Be on the right side, hold it, and be out of the way. That's the better approach to trading that type of day. So if you didn't get in before it starts moving, don't bother doing it at all. And you see it by how it just keeps pressing higher, 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 higher with no real retracements. And the trap is for you to chase it. And you'll find by doing that, you end up getting beat up. You get scared out of it, and then it won't pan out for you. You want a day that has really nice volatility. It doesn't have to be extreme volatility, but it has to move and separate. Where we've had back and forth price action. Look how it's done this here. We went above this high here, consolidated again, traded back down into the midpoint of this consolidation. Then we traded up, and then back down. Traded back up, traded back down. All of this is it's indicative of a day that is not going to be easy if you're new to see where the market's going to go to, where it should be safe not to expect it to trade back to a specific level, and how to frame multiple setups, because it's part of a very, like, the word escapes me. I know when I close the stream later today, I'll probably be on a drive somewhere and I'll be like, that's what I should have said. I should have said this. This is what the real crux of what I'm trying to emphasize. It just means that we're seeing a lot of back and forth. It's indecisive. There it is. It's indecisive. It's not in a hurry to get anywhere. And you don't want to be trading, especially with a great deal of frequency, in a day like today. Not that you can't make money, not that you can't find setups, not that you can't be profitable doing it. You just, once you do it, you want to be done with it when you get there. At minor sell side in here. Okay, so we had the bodies on this price leg run up. Body stayed inside. They didn't close above that old gap. We didn't pierce that high. We have a low taken out here. We have a low taken out here. And we pierced the rejection block there. So we have the early indication of a fair value gap there. I would like to see that stay open. If it can stay open and trade below this low, then I think we could explore over here. It can touch it and trade into it and still do that if it wants to go lower. But for the sake of pattern recognition, Caleb, and looking for gaps that want to stay open for the basis of seeing longer runs, if it were to stay open, if this little area right here, if it were completely to close in, it's less likely, but still probable, that if it drops below this low, we could revisit this area down here, because that's the low of the day, and there's a lot of liquidity on that. A lot of people that have bought down here and all through here, they've been wanting this to go higher. And every time it's doing all these types of things, it causes disenchantment for them. And if it's going to go down there, if it takes out this low, I would like to see it do it rather quickly. Whereas any other time, this would be a high resistance liquidity run. What does that mean? Because we've had multiple times trading down, 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 and finally sending it higher. Usually, this is a hard area to get down through if it's going to sell off because of that very nature, because it's been used lots of times. Okay, and then you have the top of this little consolidation. So it's a lot of order flow that took place in this old area, but because we're entering a time of day where whatever has transpired in the beginning of the day, so for instance, like 7 o'clock in the morning to 11:30, which is coming up in like 11 minutes or so, this is the point of liquidity that's framed on that first part of the session or the day. So in other words, the majority of the money has been made on what? Being long in the market or short? The longs. That's the longest profitable trade that's been going in motion today. It's the longs. They are the ones that's been holding the winning ticket longest for today. So if that's true, and the lunch hour is going to make a run against what has already been in play, kind of like a midday retracement. But these midday retracements sometimes can be midday reversals for the whole day or the week. Okay, so what I'm stating is because we're on a Friday, because it is seeing that, yeah, we did rally, but it's had a real hard time finding its groove and traction going up. Not to say that it can't start screaming higher rate from where it's at right now and just go up and keep going up. That's always a given. That's a certainty that is always likely to pan out, and then that's why we have to have stop losses. But if we can identify where the stop losses are at the beginning of the day as we went into lunch, because there's really no pretty lows in here, because if it's going to go here, in my mind, I'm thinking if it could trade below here, what would keep it from going here? I would like to see it go there. If it trades below this low aggressively and speeds up and went below that, while this is the nicer one because it takes out everybody on the day, that's the maximum carnage event. If it were to trade below this low and have some speed on the downside, I wouldn't look at this area as a high resistance liquidity run, because I would have the benefit of having, it's Friday. It's been a huge up week. Since last Monday, we've had two really big, monstrous relief rallies that came into the marketplace because the Middle East didn't explode. And we have further downside. Like we could still see a 30% retracement on the week. And that will not change the underlying bullishness of what may be in motion. So it's not like, oh, you're calling for too deep of a retracement in ICT. No, it's not. Actually, it's very good. It would be healthy to see a 30% retracement. There's nothing wrong with that. It doesn't change the underlying direction of the marketplace. I'm not trying to pick the top, right? So look at the just the back and forth that's in here. Like we get down to here, we poke it by a tick, and then there's just the back end of these candles that keep overlapping each other. It's like a picket fence. Everything's real close to the same previous, picket in the fence, the boards. They all pretty much are close to the same length and height than the next one is. That's a day. That's an indication that you're in a day that is very, very comfortable being at the price it's at. And what does that mean? It means that there really isn't any imbalance or inefficiencies that's notable to cause the market to want to go anywhere in one direction rather quickly. So you have to wait for those displacements. Once they occur in price action, then you have, now you have something to measure. You have the inefficiency. It's either a gap higher or it's a gap lower. And then you measure, how does price react to it once it trades back into that inefficiency? And then it tips its hand. It tells you, okay, I'm likely to keep going in the direction of that gap. No, I'm going up into that gap just to fade it, and now I'm going to go the other direction. There's that gap that I said I would like to see it stay open. It hammered around in here, and now we're trading right up into it here. So what I'm watching is I'm watching the body of that candle. Does it close inside or above this candle's low? Imagine you're trying to you got $250. $250, and then you've passed your combine. You'll have a funded account. And today you're trying to trade. You'll turn that, I need to make $250 into, I blew it, or now it's $1,000. I got to make $1,000 versus if I just would have sat still and waited till Monday or sometime next week where it was a better market condition, where it's easy. It's market's making really nice price runs. There's obvious, you can see where it's reaching for. That's what I'm trying to train you to see, Caleb. You've seen me working in ranges and days that it's just where I'm pointing out how fast the market runs and how far it's traveling. And again, don't be confused by what I'm referring to here and then think that that's what that was yesterday. Yesterday was, it's just one directional. Like you can't navigate up and down in that type of day. It's just get out of the way. Or you have this type of day here where, yes, there's fluctuations occurring. I kind of like revealed in the beginning of the session, I'd prefer it to trade lower. I'd like to see that consequent encroachment on this over here. I'd like to see it trade down there today. I may not see it today. It might make a higher high. It might erase the retracement on the weekly range just today. Or we could trade down below that 30% level and trade even deeper. Or just stay in the range that's already formed, already for today. The last thing I just said, I wouldn't be surprised if it did that because of how it's trading. So there's been times where I've talked about how I don't trade on Mondays. I try to demand a whole lot from the market on Monday for the purpose of using it on Tuesday and the rest of the week for directional bias, targets, draws on liquidity, that type of thing. There are times when I don't want to trade on Fridays. And a Friday that has had a really big run up, and on Thursday, say it completes the 20 or 30% retracement on the weekly range, which it didn't. It didn't do that. It did it this morning by trading here. So when it did that retracement like that, that's 20% of the weekly range. And you can test that out on your weekly chart. If it were to do a 20% retracement on a Thursday, when do I avoid trading Friday? When it does that. I don't care what the market does on a Friday in that instance then. If I have a big weekly range, the candle's been rather elongated and it's larger than the normal weekly ranges have been. And anybody looking at the last 2 weeks, they can say that they're rather large weekly candles. If that's true, and then on Thursday, before Thursday's close, we had at any time a 20% of that weekly range retrace, I will not trade on a Friday because you'll get this type of day here. Whereas we did get the 20% retracement here. Because we got that, this is for your notes. When you have that, it tends to create these types of days or sessions. And because it's Friday and it did it in the morning session of Friday, that means after that 20% retracement, then the market can become very fickle. And I've used this term before in the past, and people in other countries are like, what do you mean? Talk plainly. Talk in more simple terms, because they don't understand what I'm saying. It means that it's back and forth, back and forth, back and forth, and it becomes very problematic to see a very easy sustained price run or a multiple, a large number of opportunities intraday. Whereas a day that's not like this and not one-sided like yesterday, where you can trade both directions. The 1 minute chart gives you a lot of freedom to navigate up and down, and you can get multiple opportunities to measure 10 or 15, 20 point or handle runs and get a lot of experience and practice. And that practice becomes your model, your repertoire. And then when you have a funded account or you're trading with real money, you'll know what you're doing because you can identify the market conditions. Oh, this is a market that's going to give me some movement today. Also, by learning what I'm teaching you today, is you'll know when to anticipate these crappy market environments, because these are some of the things I'm going to talk about in 2 weeks. I just gave you one here because it's salient. Whatever we're anticipating TGIF, and TGIF can form at 1 p.m. on Thursdays, New York time. Okay, why 1 p.m.? Because you have to at least give that hour lunch, noon to 1 o'clock, to do whatever it's going to do. And then at 1 p.m. on Thursday, throughout Friday, till Friday's close, I'm always anticipating a 20 to 30% retracement. If we have a elongated, larger than the last few weeks weekly range, if it's up, then I'm expecting 20 to 30% retracement from the highest high that's formed at Thursday, 1 p.m. Eastern Standard Time, going into Friday's trading. If at any time the market has a 20% retracement, as soon as it does that, and if I have not had a trade, I am not going to trade anymore for the rest of that week. I'm done for the week because it's fulfilled its upside objectives and then it's retraced. So think about it as a daily range power 3. It's already done its movement. So now what am I going to be doing? I'm going to be trading in the uncertainty of where is it going to go? Is it going to close higher on the week? Is it going to have a deeper retracement? Is it going to close in an unchanged, no real event taking us out of the consolidation? It's going to just meander around. Think about how a daily candle closes in the last few minutes, the last 15 or 30 minutes of a day. There's little things that take off and cause markets to run, but they're not running 100 handles. They're not doing a whole lot of, excited animated movement. They're doing what? They're staying in a really small range, off the high, off the low, and they're not trying to make new ground. And they're not trying to trade back to the middle of the daily range either. So that's why you're seeing this type of action here, because it's already done this part here, the 20% retracement. So the weekly range has already, in my opinion, has already done all the work that it needs to do. Now everybody else is sitting in here trying to do something extra when power 3 applied to the weekly candlestick has already completed its role. Its function on the weekly candlestick has done its job. Now, does that mean prices is going to go sideways and never change and just create a straight line to the horizontal line? Of course not. There's going to be fluctuations in price, but the fluctuations in price are going to be rather annoying because they're not going to give you a lot of run. There's not going to be a lot of magnitude and not a distance closing in on something that's obvious that it's reaching for. Does it make sense? Let me give you a graphic depiction because I'm not satisfied with what I just said. I know what I'm trying to articulate, but I don't think it's been communicated very well. So let me try to just do this for you. Let's say, for an argument, that this is a candle on the daily. Okay, so this is daily power 3. And this is the highest high, and this is the lowest low. And let's say, for instance, that the market starts trading right there. Okay, and then it trades higher. And this is where it closes for the day. All right. So what we have here is, this is a hypothetical daily range. Let's, for the sake of argument, say that you believed in advance that it was going to be an up close day or a big bullish day. And then once it goes to a target and then starts to retrace, if we measure the high to the low that day, (20 to 30%). If the market comes off the high that it forms here, after it does that, and you anticipate the market doing what? Coming off the high. it's not always going to close on the high. If it's bullish like this, usually the close is going to be in the upper third of the candlestick. So that means here's your half. So if you do it in 1/3, second third, upper third, the close is going to be in the upper third of the candle for the daily range. That's power 3. That's new information, by the way. If you didn't write that down, you missed it. But generally, what you'll find is that when it creates its objective to the upside, it'll retrace 20 to 30% on the day. Not always. But now if we apply this same logic to a daily candlestick, do we anticipate the market closing on the highs? No. But if it starts closing on the highs, then we're probably going to have a nice retracement or short the following day. But what does it mean for this day once we hit our target and we start trading down into 20 to 30% of the range? It means it's less likely that we're going to come back to that candle's high because it's already retraced, and now it's going to want to try to settle between 20 and 30% of the range in the upper 1/3 percentage of the total daily range. Now, if we take a quantum leap outside of the daily range perspective and apply that same logic to the weekly candlestick, the elements of TGIF are simply this. When the market trades up for the week, once it's proven itself that it wants to come back and start retracing, which is what it does today, here, and trades back down into 20% of the range. That's the equivalent of this. I'm not comfortable because I've chopped up my accounts. I've hurt myself and lost accounts trading commodities, doing these types of things, thinking it's going to go back up here and make a higher high. Once it's done this for the week, I'm done. Because what you're essentially trying to say is, because we traded down to 20%, and now we're going to say this candle diagram that's being crudely drawn out here by me represents the weekly candle. Okay, because we had the high here and it traded down 20% here, I'm not confident once it does this to ever try to trade to get a new higher high. The conditions between the high and the 20% of retracement after a big up week generally creates these very lackluster, choppy, not real exciting type of days. Can it go up and take the high out and trade higher? Yes. But it doesn't do it more times than it does this type of stuff. So when can we anticipate choppy price action when not to get too excited? You want to take a day off as a live streamer, or take a session off if you trade in front of people and you're doing it live. This is a real good way of saying, you know what, I feel confident that I'm not willing to worry about what I leave on the table. I'm not worried about how my audience may see me, because this is an environment that I'm not trying to work within. Not that you can't find setups, not that you're not a good trader, you're not a profitable trader. It just means that if you spend time identifying periods in price action where it's just simply not sexy enough to get me involved with it, it isn't clean enough, it isn't obvious, it doesn't give you very clear levels of this is what it wants to do, this is what it probably will not do, and everything's a 50-50. Do you want to trade in those environments where it's 50-50, or do you want to be when the market still hasn't traded up to this level yet, and the market could potentially trade up and still reach for something, and always focusing on discounted rates going long? And then once it hits that, then you can expect that it might have a 20 to 30% retracement. So therefore, when you do get those levels up here, take the largest portion off, 80-75% of your trade off, because you don't know post 1 p.m. on Thursday when that 20 to 30% retracement can materialize, and you give up a whole lot of profit trying to just simply be greedy and hope for the biggest run. What I just said to you was something that took a lot of time for me to trust and learn and stick to, because watching price action, it's easy to convince yourself, wow, this is going to do this or that, and it doesn't, and it frustrates you. So how do you know when to avoid certain days? When do you know when to look for this? Well, I'm giving you a lot of that stuff. It's very dry information. I'll admit it is very dry. but it's things that help me say, I'm not going to go out on Twitter today and talk about what candles are going to go up and down. When I was doing all that stuff, if there was days that were more likely to create these type of wishy-washy days, like, nah, I'm not interested. I would tell my private students, I'm not going to trade today. I don't see anything. I'm not interested. That's the way it worked. Sometimes there would be a day where I wish I would have done it in hindsight, thinking, wow, I didn't see all of this coming. It came and started really panning out good. And that's going to happen too. You can't expect to be perfect. So far we've had a 20% retracement on the week, and then we have been just grinding between the 7 a.m. start and that 20% retracement in the upper quadrant of yesterday's opening range. I'm watching how it behaves in here. I'm quite certain if Caleb wasn't used to seeing me do this stuff next to him live and tell him what's going to happen and trade it and watch how it pans out and whatnot, he would be thinking like, there's no way I'm doing all this. I will not be doing all this, Dad. I can't do it. I'm not interested. It's too boring. It's dry. It won't. I just don't see myself doing that. So I understand how many of you, and I'm sure there's a large number of you that maybe started watching the stream, but then said, "Yeah, I can't watch this." But this is the part that you have to go through. Like, you got to look at price action. You have to do that because you don't know what you're going to be choosing as a model, unless you're going to force yourself into a model, which I've already produced some of that stuff already. And for some people, that doesn't work for them. Not because his concepts don't work, but it doesn't fit them. It doesn't give them comfort knowing that what they're doing makes sense to them. They can see it, why it should behave that way and trade at a certain time of day. That's a reality to it. And that's why I teach the way I do. I teach it where you'll see something that makes sense for you. And you might have a very easy, low-hanging fruit objective where if I can just get 8 handles, it doesn't need to be 10 ICT. I just think if I got 8 handles 3 times a week, that's plenty enough for me. You know what? Some of you might hear that and think, man, that's not enough. I wouldn't do that. And other people are like, you know what? I never thought about that. That means I could take 2 days off. Yeah. But you're thinking, I got to be here every day. I got to be here every session. I got to trade Forex. I got to trade futures. I got to trade crypto. I got to trade everything. And then when you start putting your hands in all of that, you take a step back. What are you really accomplishing? You're going to find that the more you try to do, the less you actually achieve at. So if it spikes through that fair value gap that's in orange, where can it spike into? New day opening gap. And because we have those relative equal highs there, we want to see, does it have the ability to trade above the end dog and maybe spike through it and touch this again and then accelerate through here? Because otherwise there's no reason for it to have been here. For it to do all this and not take that out at the minimum is foolishness. If I was Phil, I would just simply run it here, spike it up onto here with 3 candles after. But that's just me. Now think about it like this. Say, for instance, that we did not get this retracement on the weekly range of 20%. So it means the highest high and the lowest low of this particular trading week, okay? Say we didn't get that 20% retracement yet. And where we're trading time-wise, not price-wise, time-wise, I would expect the market to try to sell off to try to explore that 20%. But because we have had this happen already here, right there, it's more likely that it's going to create a lot of price action that is, it's fuzzy, okay? Like it's real fuzzy, back and forth, back and forth, back and forth. It's going certain places, yes, but it's not running like from here, displacement, inefficiency, displacement, inefficiency, displacement. You see that? Contrast this with all this garbage. Okay? When does that come into the marketplace? When is it visible in price? After it's already done 20% retracement on the week. So now it's going to take something for, well, let's say it this way. It's going to be a manual intervention for it to create a higher high on the week. There you go. And I can anticipate sometimes that occurring, but mostly I don't know when it's likely to occur. But usually it's like FOMC. Obviously, they're timed by the economic calendar. But when there is nothing in the economic calendar and the hand, if you will, comes into the marketplace and starts manipulating and driving price to a specific price level, they will come out of the woodwork at times when I don't expect it. But it will take something like that after 20% or 30% has been met as a retracement in the same week. And then if it goes and retraces and runs higher, that's always absolutely 100% manual intervention. That means they are rigging it, they're pricing it in there, the market makers, if you will. They're behind it, and you will see very, very low volume send it there. So that kind of like laughs in the face of it's buying, selling pressure. All right, so we're back in the new day opening gap. We found our way above it. Now we're inside of it in here now. You can touch this here and see how it reacts off of that. So here's a question for you. Is it something easier for the market to trade to the liquidity that's resting right above these relative equal highs? Or is it more likely to go not here, but all the way back down here? Which one's easier to do? Which one's more likely to occur? If it can run these highs, is it out of the question for it to go over here and upset where it's smooth? Does it need to go all the way back up to here? No. Why? Because this high is higher than that one. This high is higher than the one to the right. This high is higher than the one to the right. So which one's the valid relative equal high? This one and this one. Is this relative equal low seen with a lower or higher low here? It's lower on that one. So which one's more probable? The buy side. Now, what would be neat, this is how I would really do it. I would pump it from where it's at here, clear the 590 level. I would sweep 601 on a candlestick wick, just a wick, no body. And then I would slam it down below and take out the low of the day. That's how I would do it. And that would keep the weekly high in check, not take the weekly high out. It would take out the high of day session, that's here. The day session high is that candlestick right there. So that way you can sweep that. That's disturbed. This is taken out. And we're still leaving the weekly range high in play. It doesn't get taken out, doesn't get traded to, and then run it all the way lower and take out the people down here that have been trying to make money all day, continuing the run that's been done for the last 2 weeks, like 2 full weeks of up, 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 up. But knock these individuals out that are short, that would be positioned to be profitable, and knock out anyone that has a stop loss there. So they rode this down, and nudge, nudge, and then you have this. They bump that, and then it drops. But that drop would be fast. It would be furious. It would be like sudden, not a drifting, fuzzy drop like this stuff in here. Like all this stuff in here, that's too fuzzy. You want to see it look like this, where it's just riding the lightning. It's a Metallica reference for those who don't know. Oh man, play some Metallica ICT. I was supposed to close this at 11:30. This guy's a liar. You get an extra. You didn't have to pay for it. Okay, would you feel confident if you were long? And if you were short, would you feel confident? Let's say your stop loss is right here, and you're short. Would you feel comfortable right now? Watch that orange range. See if we can get a single candle come down and tap it again. Same thing for that end dog. Get above it, see if there's a single candle that comes down and touches it. Then you study that one and see if it runs from that. And you can either touch this or touch. It's got to leave it. It can't do that. That's not what I'm referring to. It's got to close a candle, come down and start a new candle, and then touch it. Either the high, consequent encroachment, or the low. It can spike as low as this one here, and study and see if it goes to these relative equal highs to bump the high of the day. And if it can reach there, does it have the moxie to reach up into and spike through these clean levels right here? All right, now watch the next candle. We hit it. Right here is where there's buy side. traded up, open, traded down, touched it, rallied. This is balanced. I'd like to see this portion stay open between that candle's high and that candle's low. How many handles is this? From the new day opening gap high to the high here. 20 handles, right? So that's a minimum for me. That's a minimum range for targeting purposes. So if it's a setup that affords me the setup to identify where price could reach, where it could start in the inception of the price run. So in other words, I can frame something as a beginning point, and I can frame something as a terminus. If it's 20 handles for NQ, that is a trade that is, in my opinion, worth it. If it's less than, I'm not interested in it. Does that make sense visually now? Regardless if it goes up here or not, it has to have the range between where the trade could begin and where the trade could draw to. Because we have these relative equal highs up here, they may bump the high of the day, which is this relative equal high. They could bump that, clear it, and how far can it clear it? We have those relative equal highs to the left. Over here we were referring to all session. Okay, so all right, so we had this gap close in. It doesn't change it. It just means that it's better for it to stay open. It would have to be below this volume imbalance for a stop, for the ones that are wondering what that would be. So your risk would be there in deference to that candle right there, that low plus a tick up, because it has to be, if you're trying to use a new day opening gap high, that's the first barrier, easiest low threshold for barrier of entry. That means you're picking the one that's most likely easiest to fill. If you're trying to get consequent encroachment of the new day opening gap, you would never have gotten filled. If you were trying to use the low of it, you never would have gotten filled. So the high plus one tick, your fill would be there, your stop loss would be below. This candle's open. That's the risk. It's not much. But it would have been better if it would have left that gap open here. I would have liked to see that stay open. But now we're going to get a real example of what it looks like when it does close it. How does it behave? See where we're trading at right now also? Let me put the good one first. Consequent encroachment of the wick. So we were trading. So we want to see if it can gravitate towards that high, or these highs rather. I promise you, on cleaner days, it's going to be a lot more fun, but you have to go through these days because you're going to trade with these type of days as well. So it doesn't do you good. And this is what I was trying to teach my students in 2016. When I would go through and point out certain things in price action, to start giving them a baseline to what to look for, what's important, what's not all that important, what are going to be things that are concerning for the trade, for the idea, for the price to be moving a specific level, or how it should deliver. I had so many people quit the first 2 months because they were not willing to sit and observe. Because you're not, how can you identify something? Like how can you identify it? If it doesn't pan out, with repetition, if you will. If you don't see it constantly, panning out, how can you identify it on your own? Because if it was easy and it was something that everybody can do, everybody could write the same book, reword it differently, but it's the same pattern or same thing that occurs in price action. And then we wouldn't need to have people like educators and mentors and stuff. They could just, everybody does the same thing because we can see it one time and know what we're doing. Do you have that drop down in that consequent equation with an end dog? That's pretty sharp. So you have to sit and watch. And by watching and forcing yourself in days where it's going to be harder for you to do it, pretending that it's going to be easy. And if I put my students in conditions where it's obvious, it's easy, it's going to be really easy, fast runs to everything that we point out, that gives you a false sense of security. It makes it feel like, well, I'm ready to go out there and trade with real money. But when you start watching price action over more challenging conditions, which we are in challenging conditions, anyone that has been trading longer than a couple years can tell you that how we're trading now, these are very difficult market conditions prior to, let's say, 2010, okay, or 2007. Totally different kind of market conditions. They're a whole lot more volatile, which is fun, but that volatility comes with it with a price. And it causes a whole lot more opportunities for the market to be challenging. So we have this market trade above this high there. So that would be an opportunity for you. If you're going to be doing partials, you have to entertain the idea that would be a partial because your first high is here. Terminus is here. Terminus is where you think the trade is going to go to. That means it's going to book price to that price level. That's how you frame it. So if you think price is going to go to a particular level in your notations and your annotating, that's terminus. That kills the idea for you and you're satisfied. It does not mean it can't go further. It just means that that's what you're trying to frame for that move. And if it affords you in here, when it touched here and it rallied to this high, when it retraced back down in and ran up one more time, as soon as it takes out that high, this is called running down equity. Okay, my private students know this. I don't know if I mentioned it in any lectures. I don't know if I did that publicly, but all my private students know this. And anytime you're in a trade and you're long, if you have a short-term high before the run gets to your target, but it has to be at least 50% of the run. So in other words, if it gets halfway to where you think it's going to go, what does that mean? This is where we were watching it start. So from here to here, that high is above it, isn't it? So if it passes through it one time, you have to take a partial there. So if you're learning how to take partials, your partial will be taken there. That right there, that would have been stop. So you would have partial 1, stop on the balance. You log it. How much time did it take? Entry on one candle, 1 minute, 2 minute, 3 minute, 4 minutes for partial. 5 if your limit order was a little bit higher. Let's be real and say it's 5 minutes. 5 minutes, and then you got stopped out on 6, 7, 8, 9 minutes. So 9 minutes into the setup, 9 minutes you're stopped on the balance, 1 partial, and you go to the next setup. So it gives you data. It gives you how much time did it move. What was the distance from the entry? 70 to, we'll just call it 10 handles with spread, both in and out. So you can go in and start now. Let me take this off. I promise you, it doesn't feel fun, but this is all the stuff that you use to figure out where to place a stop loss, where to take partials, when's the market going to be harder, how to frame the setup, where's the terminus, what's the first threshold that you have to breach before you can even consider taking a partial, not just because you're in a trade and you're up $500 and you've never seen that before. Let me just take something off because I'm afraid. That's impulsive, that's emotional. So you have to have rules and processes and protocols to follow. And over time, it'll give you more and more experience and you'll trust it. I'm watching how they're wicking in this all here. We traded back down into the volume imbalance, so that might be just an area where they have reaccumulated. So I'm watching to see, can we maybe entertain the idea of getting back above this here? If it touches it, we'll try to do another observation on that one. So we traded once more here. I would have, if you remember back here, I said it could trade back down and touch this one more time. It did a little bit too late for my liking. So now I would demand for it to trade above, get into this one, and then treat that same fair value gap again. A new candle, it's got to go above it. New candle open, go down and trade into it. Then see if we can start setting up here and maybe challenge the high of the day. If we lose this gap here, then I will change my focus to weakness going into the close. But right now, my focus is here and maybe as much as up here. Let's leave it on the screen. But you can see how we rallied, gave a little bit of range, came back, dug in deep. Now, I know some of you are actually taking these trades, and you should not be doing it. You should not be using where I said this is where the stop would be. Don't put your liquidity there because there's so many people following this live stream. By you doing that and the market's this close, you're creating a very easy target for them to push a button, open the spreads, make it run, and go right down there and fill it. You get stopped out, and there you go. I'm teaching you how to read it. And when you read it, you're not on the internet with 20,000 people telling them to put the same stop loss where yours is at. All right, see, it spiked above it there, but didn't give me the body. I want to see it go above it, close above it, open a new candle, and then see what we do by touching it then. If it does it, I think it's going to be real fast. Like it'll run real quick, if at all. If it's going to go up there and take those relative equal highs out, it'll be a fast run. Because we're real close to high day liquidity, and they're not going to want to let them pull those orders out. So how they overcome that? They do a real quick, fast, sudden run. Okay, watch this candle here. Sixpence, none the richer comes to mind. Song Kiss Me. I want to see it just touch that right there, but I'm looking at that wick and it's just real hard to get just the consequent encroachment. It went into that. All right, now go back to that analogy. Your stop loss is here. You've been short all day. You've been feeling sexy. You've been feeling smart. Do you feel good right now? Say you've been smarter than those guys and you've had your stop up here. Do you feel smart? Do you feel safe? The next candle should send us. Imagine your stop loss is sitting right there at 592. And you're thinking, I really wish I would have listened to Taking Partials, the ICT videos talks about. So now for here, what's to say that we can't run up there and take that 601.50 level out because it's too smooth up there. Too smooth. Why would they let them off the hook, right? If you're so close to that, why not just simply put a pairing of two orders, a short and a long, right at 601.75? So all you got to do is match up one market order, short and sold, and long and short, basically. And then all of a sudden, the folks that have their stop loss at that level or just above it, they get engaged. But there's no honeymoon afterwards. It's divorce. So you want to screenshot that. Okay. So I've given you instances where you would read it, you get a partial, you get stopped out, you look for it to give you a fill, it just falls short of touching it, you wouldn't have been filled there, but then it runs. So in a real world, while you're learning, this is what it's going to feel like when you're doing your observations. You're going to have a good feel for what it's likely to do. You're going to have a real good inkling that it's going to go to a specific level. I think it's going to go there. I think it's going to go here. And then you're going to look for certain things in price that may or may not afford you an entry. And now you're met with either you're going to be frustrated or you're going to say, you know what? I saw where it was going to go and it went there. So now I feel confident that I can stick to doing this next week. I'm going to study price action and I'm going to get better at this because I see there's something going on, but I can't quite put my finger on it yet, but I feel like I'm getting closer to it. If you feel that way, you're on the right path. If you're here thinking there's no trade being taken, this is dumb, well, that's an indication that you need to go somewhere else because I'm teaching people how to do it on their own. And the ones that make money, and you see them out there, card-carrying members of the ICT cult of winning, they will tell you that they had to do stuff like this too. And it didn't happen right away. It wasn't easy. It wasn't fast for them. And they had doubts, and they had other people, and still people that are my students that are making money, they're still being trolled because these people are miserable and they're broke and they're never going to make money. And they will never have attention placed on them greater than the person they're trying to troll. If they give them the grace of saying anything about whatever they say about them, that's the extent or that's the pinnacle of their existence. So are you going to would you let these people, anyone that's going to try to talk down to you, if you are making money and you start making money and you're profiting, would you let their criticism have any impact on you when you're making money? No, you wouldn't. It wouldn't bother you. So why will you allow them to influence you while you're learning? If you already know other people are using this information and they're making money with it, you already know that it works. You just need to know, will it work in your hands? And the only way you're going to know that is if you start. And this is what it looks like when you start. I'm trying to be as practical, I'm trying to be as real, and I'm putting you in conditions that you're going to be met with. Every single day, whatever the market throws at me, I will engage it and tell you, this is what you should be looking at. This is what may or may not happen. I don't like this. I do like that. I'm explaining it where it's salient. That means where there's something to explain away, and also how to ring in the retail. Like the traders that are trading a certain way, how do they get bothered? How they get disturbed? How can they be taken out of the market if they've been right, if they've been wrong? Now I would sink it all the way down to the low of the day, going into the close. That's what I would do. That doesn't mean it's what's going to happen though. But that's exactly what I would do, because that means anyone that was short, they're out. Anyone that's long feels rich right now. And the way you do that is you do a sudden crush and you just send it lower. But I think that's going to be it for this week. I really had fun this week. I had a lot of fun. I wish I would not have live streamed yesterday simply because my attention was elsewhere. And I'm probably going to have to start the stream sooner, simply because OBS is mucking around with me. And I don't know what I'm doing wrong. It keeps causing me a problem where I can't load it up. And I don't know I don't know any other streaming software that works with YouTube. And I don't want to venture to try to learn anything new either. So it's kind of like I want to see this get resolved, so that way I can, when I start a stream, it starts off without a hitch. Because I'm obsessively compulsive, and you probably picked that up over the years listening to me. And when I get jerked out of gear, it takes a minute or two for me to get my bearings and try to forget about something that's either upset me or bothered me. But I hope you guys are learning, okay? And these first couple weeks, they're boring. They're really, really boring information. And it's important that Caleb is reminded just as much as you, if you're trying to really make a good attempt at learning all this stuff. You're only going to be as good as the market environments that is presented to you. And Bob Ross, as beautiful as a painting that he can paint when he was alive and with us, and as cool and as mellow as he was while he was doing it, I'm quite certain that if we would have asked him while he was alive, say, hey, listen, Bob, this brick wall is your canvas today, okay? And I'm sorry I didn't bring any paintbrushes and you aren't allowed to use any of yours, but I have these spray paint cans, okay? We have these spray paint cans, and we have 8 of them, 8 different colors, and we want to see you paint a snowy background with a little cabin with these happy little trees, and we want some birds, and we want a little stream that has some ice on parts of it, but not entirely all of it. And we expect to see you do that in 30 minutes and keep us entertained with some mellow jazz coming out of those vocal cords. Well, I'm quite certain that Bob Ross is going to fail doing that, because number one, that's not his typical canvas, and it's also it's not his medium. His paintbrushes are not his tool. They're not there, rather. He's being asked to do something in a canvas with tools he's not used to doing or using. Well, there's going to be times where your tools will not be accessible to you, and it's going to be dictated by the market environment, how the market behaves. If the market doesn't give you your price, you can't do anything about it. I mean, you can get mad and you can get angry because you just had one exposure to it, trying to do it, and you think, well, it didn't work this time, so it's probably never going to work in the future. And that's not realistic. Anyone that is trying to educate and they're not reminding the people they're trying to teach, probably when they're any real skill, and they're not reminding them or showcasing or giving them the realities that you can have all the things in the world that's going to afford you an entry mechanism to get into the marketplace, but the market's going to do what the market's going to do. And if you do it wrong, you have brought in the element of humanity. I am a human just like any one of you. I can feel much more confident about a setup than I should. I can feel less confident about a setup than I should. And I may not see a setup at all because it just jumps out at me because I'm either distracted or I'm just not paying enough attention because I have something else on my mind. You're going to encounter that as well. But you need to give yourself the opportunity to study price action when you feel a little bit of anxiety, when you feel like you're having a little bit of things in your personal life bothering you. Measure your response to what price is doing in those instances. You're going to get huge revelations in who you are, how you think, and how you're going to react afterwards. Because if you have an adverse result, say you spent hours in front of the price action and you felt like you didn't come away with anything, it felt like it was unproductive, how are you going to treat yourself the rest of that day and the day after? On a day like Friday, how are you going to treat yourself throughout the entirety of the weekend? Are you going to punish yourself for not knowing enough, not being able to do it? Should have known better, should know more by now. I should be making money with this. I'm going to quit if it doesn't start showing me anything next week. How do you think? Because if you start feeling toxic like that, and if you really want to learn how to do this, you have to I'm reminding you right now, it is not going to be that fast for you. I have never had a student, not one student has ever come to me and inside of a couple months figured it all out and they're making money. It doesn't work like that, folks, because you have your own issues that you have to identify and then build coping skills around them if they're extremely toxic. That means impatience, highly critical of yourself, of everyone else, unrealistic expectations. You should be making money within a month. That's what you're thinking. And that's not true. That's not true. My son, I want him to make as much money as he wants and more. But I've already told him he will not see profitability shorter than 6 months. It won't happen. And you get to watch it. You get to see it. You get to see it unfold. Every step, every lecture, every lesson, I'm making it available to you. I mean, look at me. They're very long. They're not short little 5-minute videos. They're not 30-minute videos. I'm going over live price action and I'm talking about what he's probably going to feel, what he probably is feeling when he's watching the price action. And I'm explaining the do's and the don'ts and why and where it's salient, why it shouldn't, what's important to me right now and why should it be important. You don't always know what price is going to do next. You're not going to know that, okay? You're not going to know that. So you're going to have to subscribe to uncertainty. And trading is embracing that uncertainty, but having enough experience, seeing certain things that you use as a catalyst, as the reason for you to get involved or engage price action. These things will become characteristics that you see repeating. They may not all be there, but if a number of them are in play and you see it in price action, that should bolster your confidence to at least explore it. And over time, how much time? I don't know for every one of you. You're all going to do it at a different pace. But when you have a daily interaction with price action, whether it be hindsight or real time, preferably real time, if you cannot watch price like I'm showing you here, the best thing you can do is watch the streams. Watch the recordings. If you can't watch it live, watch them at the same pace. Do not speed them up. If you speed them up, you're getting a skewed perspective. It's not the same as watching it real time. Doing it at 2 times the speed because you want to get through it because you ain't got that much time, that's the wrong way of doing it, because you can't speed up your understanding while you're watching live price action. You can't do that part. Don't think of it as I'm getting through it quicker and I'll be able to watch more videos, because more videos is not it. I've already told you, you're not going to win in this progress by watching more videos. You need to be watching price and then how you feel, what you're thinking, what you're fearful of, when you get elated and feel like, oh yeah, this is working out perfectly. And you need to make annotations about when you feel that euphoric moment where it's perfect, I know it's going to happen. And then when it doesn't and it turns back on you, what do you feel? Do you feel embarrassed? Do you feel like a failure? Do you feel like, oh, it's never going to work for me? And you need to be honest with yourself in this part of your development, the very, very early stages. And then if you discover that you're very toxic to yourself, you need to start replacing those toxic ideas and opinions of yourself and your efforts while you're doing this, and reward yourself for the effort to keep doing it and say, you know what, this gives me opportunity to see what did I miss? What would I have done differently now that I've seen this? And is there any investment that I can make in myself by having this exposure that was adverse? And you do it in a very disarming way, so that way you're not punishing yourself. Self-talk is absolutely critical in this, not just when you're still learning how to trade, but when you are a trader, because you're going to have losing days. You're going to know, and I'm saying this and I'm closing, you're going to know when your model is there and when to engage it. And there's going to be instances where you feel externally, you feel this desire to compensate for something that's occurring or has occurred in your personal life. Some inadequacy, some kind of mistake you maybe said. Maybe you said something, maybe caused an argument. Maybe you're not feeling well, or you missed an opportunity in the previous day. Maybe you lost your job or are on the verge of being made redundant at your job, and they may get ready to give you a pink slip and send you on your way. You feel something is looming. So you go into the marketplace and you force something. You tell yourself, yeah, it's there. I'm going to take the trade. I'm not going to wait for the real setup because I just need to be in there, because if it pans out, it'll make me feel better than I feel right now, because my real life outside these charts while I'm learning how to be a trader, I need a distraction from that. And these candlesticks are not used for that purpose. If you treat them like a siren, they'll call you to the rocks. If you invite them to be that trick on the corner that you need to release from, you might be able to afford that real quick, friendly handshake with her or him, but you might not like what you get on the other side of it. Same thing with reading price action. It's either there or it isn't. And the only way you recognize it is by repetition, seeing it. You'll watch me for weeks and months do this, and you're going to start seeing the same things, and it's going to be boring. That's exactly what your goal is. You want to be able to finish my sentences or predict what I'm about to say based on what the candlesticks are doing. Nothing pleases me more than seeing individuals show their trades recorded, annotate them with the same observations I would have, and many times have, because that means you're on the same wavelength. You're seeing the same thing. That means you have received what I put down. You received that transmission, that download of intelligence left me and went into you. And that's proof of concept. And that's also proof that if other people can do it, women, young and old, men, young and old, different cultures, different race, different backgrounds, hey, if they can do it, why aren't you able to do it? What's going to prevent you from doing it? I'm going to tell you what's going to prevent you. Not subscribing to what I'm doing here daily. Not doing those things. Doing it like this. You have the benefit of me doing it with you right now. When this gets to the point where Caleb is now able to do on his own, I won't be doing this. And you'll miss it. You won't have the ability, the same effects of watching it live. Seeing when it's obvious, when it's not obvious. When things change gears and it becomes much more clear. Oh, now it changes. That's something you have to see as it happens. It can't be communicated in a book. A static picture, a paragraph, 3-4 pages of it isn't going to give you the answer, because it's going to feel like, well, he has the benefit of having known at the time what the price is going to do. But I don't have that safety net here in front of you with real-time price action. So either the methodology holds up or it doesn't hold up. And if you don't see these things, repeating to a degree of repetition that warrants your interest to keep showing up and watching or studying, by all means, please go watch someone else. You don't have to give me the middle finger out the door as you go. You don't have to let the door hit you in the ass either. It wasn't your thing, and go chase something else that you think is going to be a better fit. And whatever it is, if it's not my stuff, if it works and it makes you money, man, God bless you for that. Like I want all of that for you. I don't want to hold anybody up. But I also am honest. I'm not going to hold you up with useless things. I'm going to put you through the things that you're going to have to do to really learn this. Understanding why it's going to take place, why it shouldn't take place, when the odds are against a certain thing, when the odds are still 50-50. And you're going to see when I talk about, well, this is a nice, clean market. That means you want to record today's recording, today's live stream, today's episode or whatnot. This is a day where you want to put it in your journal. That day, August, what are we on? 16th, 2024, was a very fickle day. Whenever I say we're in a market that's probably going to be fickle today, or it's being fickle, what does that mean? You're going to have a whole lot of fuzzy price action where it's overlapping constantly, back and forth, back and forth, back and forth, and it does these little sputterings, and then that's it. Then back into fuzzy price action, and then when you get to lunch, whatever has happened in the day, they'll make a run against that, and then you have the afternoon. On a Friday, there's no telling what they're going to do. That's why in the afternoon, if I haven't made money in the morning on Fridays, I don't go in the afternoon and say, well, let me see if I can get, I don't want to do that. I have had losses on those days because I'm trying to fill in a void where maybe I missed a move in the morning and I wanted to trade it. 32 years of plus doing this, I still feel human impulses to be more involved than I should. And I have seen that when I try to go in on a Friday, if I haven't done anything all day, or maybe I missed it, or say there's an instance a few times in my memory now I can remember where I was ill, I was physically sick, and I wasn't able to trade all throughout the week. And I was like, you know what, I got time. I'm going to go out there, and I only have like an hour and a half left in the week. And it had a pretty good move for the week, and it's obvious that I think it's going to do this or do that. And I go in and I engage in it. And then it starts moving in my favor, and I start pyramiding and pyramiding. And then I put a stop in where it should be protecting it, but it runs up and tags it. It eats away, and I didn't take any partial. So what I've done is I've committed too much to an idea, didn't follow the rules of taking partials, and I'm building a position and left the stop in a position where if it takes me out, it's a losing trade. Is it losing a lot of money? No. But I gave up all of what I built up, and now I have a loss psychologically and emotionally carrying it into the weekend, knowing full well that I've told myself instances beforehand that I shouldn't do that, and I did. So you're not going to discover where your pitfalls and snares are until you start logging them. But nobody wants to do those things because it encapsulates and makes a monument to frailty and failure. But as a trader, you want to really identify what they are, because you'll never be able to fix and address them and replace them with the right stuff unless you identify them. But the young generation that wants to run around and be chairmen and mentors, okay, and have a voice, they don't have the clout behind them to promote the validity of having a voice. They're parroting. They're parroting me. They're parroting other people. Anything that's written in a book, that's what they're saying. They've memorized that script. And they just sound smart to people that don't know anything about what they're talking about. And it's altogether something different when you get out here and you're literally over a live price action. And we're not talking about just following some indicators. There has to be a logic. Explain what should take place, why shouldn't it take place, when and where it should. And your audience, your student base, if they see something that they're pursuing and they see the evidences of it, if they see the things that are starting to pan out and all the dots are starting to connect. And that fuzzy image of what's the future look like for them starts to come clearer and clearer and clearer. And then they can start seeing, wow, I can be a trader that takes a trade that's a breaker. Here, here, here. We're trading inside these last two up close candles right in there. So if you're going to use that logic, what are you going to use as a stop loss? If you have that PD array understood, not just simply a new day opening gap and a volume imbalance. Your stop has to be down here, right below that low. So while Caleb will be using fair value gaps as his entry model, he'll have to grow out of that before he's allowed to get any more information from me. You, just like he's learning other PD arrays that will complement. So I've had students that come to me and say, I'm going to make the order block my entry method. Okay, well, you now just made it harder because there are all kinds of order blocks. Which one are you going to use? What's the framework within that order block's use? What are you trading on? It's not just I'm going to buy a down close candle, I'm going to sell short an up close candle. There has to be some kind of framework. And I gave you a challenge this week. I don't know what day it was, but I know I mentioned it this week. I said, can you frame what your trade idea, can you draw it out with a line? Like draw it out with a line depiction. Because if you can't draw it out on a napkin or a piece of paper to explain someone what it is you're trying to do, you don't really know what you're doing. That that is your first goal, to know before you start pressing a button with the demo account. Okay, you need to be able to draw it. You need to be able to draw a depiction of what it looks like as a buy, what it looks like as a sell. Where's your initial stop loss? Where's your initial partial? How will you close the trade at terminus? I'm not talking about how many contracts or what your risk management is going to be, but what does the framework look like? Because if you can't do that, guess what you're indicating? You're indicating that you did not walk the woods with daddy. You did not hear the crunch of the snow under your boot as you were walking on snow, following footprints of a deer, an elk, a bear, whatever it is you're hunting. Whatever dad's trying to teach you that we're going to hunt today, you didn't go out in the woods that day. You didn't follow dad into the woods. You didn't spend any time trying to remember what these footprints look like. Because if you understood what those footprints look like, you can draw a crude depiction of what a deer track looks like, a bear paw print, an elk, whatever it is you're hunting, you'll know what it looks like because you've seen it enough times. So how can you be mad at yourself if you can't recognize a setup because you've never spent time studying what a setup looks like, the one you're hunting? You don't know what you're going to hunt yet. So by watching live price action, it will teach you what it is it's going to be easiest for you to see. Every hunter does not hunt everything. They go out and they hunt deer, they go boar hunting, they go bear hunting, whatever it is they hunt turkey hunting, duck hunting. Now you might do duck and you might do deer, but you're not hunting everything. You don't have enough time to do it. You have a job, you have a family, you have whatever you're doing, NASCAR. Now we're talking ICT. Hot damn, we're talking some shit now, ain't we? But you have to be able to be in here looking for your setup. So while we go through the coming weeks, it's not necessary for you to do it yet. If you're brand new, if you're really trying to make a serious attempt to learn how to do this stuff, it's not realistic for you to know that yet. But just know that that's a homework assignment that every single week that we spend together, you need to be thinking, how did this build in any more understanding about what price is likely to do that leads me to a pattern and a framework that sets up a trade that has a beginning where I buy or sell, where I can place a stop loss that is finite. That means it's not imaginary. It means I'm literally going to put a stop loss there, and if I get stopped out, I'm okay with it. Where would be the first partial formed, or what's the logic behind where the first partial would be taken? All of this can be added. Some of you are going to be like, well, you can't do that, ICT. Well, you don't know what you're talking about. Okay, that means you just don't know enough yet, but you will. Just stay with us. Stay on the train. It's not costing you any money. But I promise, because it's my son's end result, it's in mind. Remember, I'm not doing this to entertain you people. I'm doing this to give him what works. And I'm giving him a framework to study. This is how you do it. This is what it looks like. And because sometimes he's working, he has to watch these live streams after the fact. Just like you that work, have a job, have college, you're sleeping because you're not watching this time of day. You want me to get up and trade Forex in London for you. Okay. These same principles are going to be those same time frames in other assets as well. But I'm not interested in answering everybody's request list. That's not why I'm here. I have a job to take care of, which is teach my son the right way. It's the way he's going to have to learn it. And this is what I've preached to all of you. If you paid me to learn how to do this, I said all these things before. And I was doing these things in live stream every single day in mentorship. The first year, I literally did this every single day. And it was monotonous. It was boring. It seemed like, oh, he doesn't know how to trade. When you didn't realize I'm literally giving you a baseline. You have to see these things. I know what I'm looking for. I'm not looking at every one of these things today. I'm looking for one or two things and I'm done because I know what I want to trade on. But I have to give you as the student, and specifically my son, you have to bring your own personality into this. And you have to grow at your own speed and your own pace. And since it's my son, I'm okay with it. As long as I got breath in my lungs and I can have my mental faculties, I will be here doing this. because I want him to succeed. And I want his brothers to have the same reference material. Should they say, well, you know, I'm going to go through what you went through, they'll have it. It's here. They can see it. But none of them wanted to sit down and do this part. They all just want the money. They all want it the easy way. So in that regard, for some of you, or all of you really, you all just want a real quick, short way of doing it. And you think that I have that for my children, and I don't. This is what's essential. They have to do this just like you. You will not understand Enigma unless you have these baseline understandings. That's it. So for people that say they figured it out, they cracked the code, you're a lying piece of shit. Period. Okay? Period. So I'm going to leave you with that. I will wish you all a very pleasant weekend, a safe weekend. Try to relax. Don't spend too much time. If you've been with me each day, live, don't do too much on the weekend. Relax. Use that as your downtime because you can burn yourself out really fast. This is a lot of time being invested, listening to me, and you're not really paying attention entirely. It's easy for you to just phase in and out, but there are a large number of you that can't be here, and you're complaining about the length of these things. If I'm trying to teach you live price action, and it needs to be done over live data, how is it benefiting you if I'm talking less when you have to get a comprehensive understanding of what the market's going to do over the spectrum of a whole trading session? Like, that just proves a myopic perspective. You don't even know what you're supposed to know to even ask the right questions. And that's not to be condescending to you if that's how you feel. That's why I delete your comment or I ban you. When you're commenting stuff like that, you talk too much. I don't ever want to hear from somebody like that because you're telling me the clearest way that I'm not here to learn properly. And I don't appreciate your time and your effort because I don't need to do this for you. I'm doing it for my son, and I'm hoping it's going to inspire him enough to show results to his brothers where they will get jealous. I'm trying to create jealousy in them because they're boys. And just like every other boy, they want to pull out their dick and measure it against somebody else's and say, I'm bigger than you, bub. And I know that that will make them want to do it. If one of them's doing it, they all want to do it. When Cameron was making money in Top Step, my youngest son, Dad, can you teach me how to trade? But the same TikTok mentality. I sat down with him. I did one day with him like this. And he was looking at his phone. I said, put the phone on the counter over there. And he's staring off into space and he wasn't watching the chart. Attention span's too small. He wants it right now. And that's the problem. Drive-through menu mentality. Give it to me right now. And the time I spent from driving my car to one menu to go up there to receive the food from you is too long. And I can't tolerate that. Like, I have no tolerance for that type of shit. And that's why I teach the way I do. I sound like a hard ass. I sound like a prick. And I'm very, very direct. And I don't care about your feelings. Because the market doesn't care about your feelings. It doesn't care that it feels harder for you to learn this. It doesn't care once you arrive and you get your profitable model. It doesn't care that you have that profitable model. It's going to do what it's going to do. If you're in it and you make money, it doesn't care. It's indifferent to you. But you're going to personify it like it's hurting your feelings. Because you have the wrong perspective. You have to be 100% responsible. And you don't know how you're going to react to determine the level of responsibility you have until you go through this stuff. You have to put yourself through it. See it. I don't care who it is. People that like me, don't like me. If they have a model, if they have a software program they designed or they use or they sell, whatever. They all did this shit. They sat and they watched price action and they had to get used to seeing these things happen. When you're trading, what do you think is going to happen differently? You think that they're going to speed the fucking charts up for you 2 times the speed? Do you think that annotations are going to pop up on your fucking chart? There's a trading view indicator. The ICT, inner musings of ICT. You're going to watch price action. And everything that I'm saying here, when price is ticking and where I think is interesting and what it should do and what it shouldn't do, there's an indicator that's going to pop up and populate all that stuff on your chart. You think that's going to happen? Because it's not going to happen. Your chart's going to be naked until you scribble whatever it is that you put on it. Or if you leave it open, whatever happens by your observation of watching price action, that's what you're left with. That's the reality of trading. You don't know what the next candle's going to do. You don't know that. You have no idea where it's going to go. But we study to get a baseline on how we can predetermine the most likely next draw on liquidity. And that's the basis of profitable trading. Know where it's going. And then have a pattern that you trust, you've seen many times over and over again, pan out, that leads to a reason to be in that move and ride it to that draw on liquidity, where you think it's going to go to. And there's lots of ways to get into a trade. But I don't want to force you into a mold that says this is the best one for you. So as a reminder, as I close it, this is another week behind us now. Caleb's being forced into fair value gap. I promise you, I swear to Christ Almighty, it's not because the fair value gap is the best. It's just the one that's easily visual. You can see it easily in the chart. It doesn't hide. When there is an obvious draw on liquidity, he will be using a fair value gap, and he will buy one tick below the high of a discount fair value gap. He will sell short one tick above the low of a bearish fair value gap. That's his entry technique. I've already told you now. Okay, I've told you this yesterday. I told you at the beginning of the live streams last week how he's going to get in. If you're just wondering what the model is that's going to get him in, you don't need to watch my videos and stop bitching about it in my comments, because nobody sees them but me. And I see them one time and I never see it again. You'll never be good at this if that's what your mentality is. But just knowing where a fair value gap entry is doesn't mean shit. You have to know where the market's going to grow up to or reduce down to. It's going to go up or it's going to go down. And it's never going to be a straight line for you. It's not going to be like that. And you're going to be met with, as I'm going to talk about in a couple weeks, when it's challenging, how to overcome holding on to an idea when it's not so clear that it wants to keep doing it. How to hold on to a trade. I get that all the time. I've given lots of responses to that this week. I've given you things on how to frame a trade with stop loss placement. I've given you things to think about if you get stopped out, how to revisit the same idea and get back in. I've given you instances where you could use that same criteria and it would be reasonable to anticipate a level B trade too. And if you used that, it would still run away without you, but go to where you thought or I said it was going to go. There's no shame in that. I'm teaching you how to disarm yourself, because that's the stuff that all my students that bitched and cried to me in the beginning, that finally found their way through it by doing this stuff, by journaling correctly, not beating themselves up, not talking themselves down, not inviting asshats on the internet and their bullshit commentaries and their insults and criticism to derail them. It's easy to do. You give the devil a seat at the table, he will come and dine with you. Don't invite him. Don't invite him. Keep your business your business. Don't tell other people what you're doing. Don't give progress reports to other people that you know that now they know that you're going through this, because they're never going to encourage you. That's not going to happen. That's not going to happen. They're going to give you 15 reasons why you should not waste any more time. And these same people talking to you don't make a fucking penny. They don't make a penny, and they probably work at fucking Jiffy Lube, and they never had a job better than that one. So I'm closing it. You have a lot of homework through this week, Caleb. Lots and lots of things to go through. But we'll be back at it again on Monday, Lord willing. I will see you then. Until then, enjoy your weekend. Be safe. And I think I mentioned we're going to work on the foundations of entry next week. So we've given some basic rules for drawing liquidity. That will be every single time. So it's not like I'm done with that. Every single lecture will be working around draws on liquidity. But now we're going to be working with elements of entry. So that way we can start looking at it with the perspective of, while tape reading, what should I be expected to see? What should it do? What shouldn't it do? So we're going to be using the fair value gap with that in mind, framing the logic of what an entry would be hypothetically, not pushing a demo button, not entering a trade, but building that so that we can study it, watch it over time, and then you have that skill set that when I'm not doing live streams, like if you want to watch the London session, if you want to watch Forex, if you want to watch the Asian session, you'll be able to do that stuff and not require me to be doing it with you live. So it gives you the resources and the practice, the processes and protocols to go through for you to be able to do it without me. Because you got to be involved in this even when I'm not doing it. Okay, so that's it. I'll talk to you next time. Be safe.